The reality is the fundamentals are still sound.
I don't think we have yet seen the real bubble trade in AI.
The market's done a little bit of work here to take some of the froth out.
I think you could have a situation where the Magnificent Seven become a little less valuable and the rest of the market becomes more valuable.
We think there's a broadening out.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome to Bloomberg Surveillance. Stocks taking a breather after the biggest two-day gain since May, with investors looking out for retail earnings and data later this morning. President Trump lowering the temperature even further with China, with plans to visit that nation in April. And Alphabet exerting a new influence over the Magnificent Seven, with futures surging on reports that they're posing some competition, Danny, to NVIDIA.
I just want to extend my sympathies for everyone like us who have had to all of a sudden do a deep dive on TPUs versus GPUs. But that is the place we're in. There's some real churn underneath the surface of tech of who is the winner of AI. The market still hasn't fully decided that. The price action, I think, will be interesting today. Can you continue to get a rebound if NVIDIA isn't playing along, even if we've decided, at least for now, the new winner is Alphabet?
Yeah, can you get a dispersion in the Magnificent Seven, in the big tech space, and not have an overall market rollover? This is the key question. We saw this yesterday when there were questions about OpenAI and Google once again posing real competition to the entire model with more profitability. And now a real question of whether they could supersede, maybe not NVIDIA, but clearly the other Magnificent Seven. It's clearly right now number 3 in terms of market capitalization, very much on course for $4 trillion.
And it's added so much to the S&P 500, just given the rally we've seen over the past month. So does it mean that we have all of a sudden have chips that are more energy efficient, that have better use cases, not as broad, but more efficient at doing the task at hand than NVIDIA? The problem with that is that NVIDIA has created this really complex web. So it's not just NVIDIA that suffers, it's Microsoft, it's SoftBank whose shares are getting killed today. OpenAI maybe has a problem, Anthropic has a problem. Just these interrelationships mean that it's bigger than just one company specific.
This is clearly an area that is rife for some sort of disruption, which is very clear to a lot of people, increasingly so as we see some of this price action. We'll get into your studies on GPUs versus TPUs because you'll whip out your PowerPoint presentation, and I'm sure everyone will actually be really interested in it. We do get a bunch of retail earnings this morning, and I think it's interesting. Before the market opens, we get Burlington, Kohl's, Best Buy, Dick's Sporting Goods, Abercrombie & Fitch. After the bell, we get Urban Outfitters. To get these earning reports in the kickoff season of the holidays really creates some possible visibility into consumer appetite.
Because I think there are now some serious questions being asked about the consumer. There are being more cautious things put out there. BMO, for example, did a survey of 1,000 consumers, and they say that holiday spending will be more modest this year. There was also a report on Carnival from Barclays yesterday that said we went and we surveyed the management, and they also seem more cautious. Cruise lines have been these things that people have pointed to, saying, look how good the consumer is. What happens if that's starting to soften?
Yeah, and yesterday you did see about half of the S&P 500 stocks not participate in the best two-day rally going back to May, including Carnival shares, to exactly that point, because of this fear around the consumer. Later this morning, we also do get retail sales data coming out for September. Some interesting Fed speak over the past 24 hours. Mary Daly lining up very squarely in the camp of Chris Waller and potentially John Williams to cut rates. She's not a voting member, but she has never departed from what Fed Chair Jay Powell has ultimately voted with. And it really is signaling to markets, guess what? They're going to cut.
And this is what it's come to, right? Of reading tea leaves, trying to figure out which way Jay Powell leans, because we haven't heard from the man himself. And just given how divided the Fed is, the thinking goes is that Jay Powell will have the ability to sway to cut or not to cut. And to your point, because Mary Daly is so aligned with Chair Powell, we're looking to her for direction.
So right now we're looking for direction in equities. You are seeing a bit of a bounce back from earlier lows. Still off, though, still lower. Down about 0.1% on the S&P futures. You are seeing yields just marginally creeping higher on the long end. Yesterday, we did see an auction that did tail 10-year yields 4.03%, still lower than where we were yesterday, and crude off just about 0.33%. Coming up this hour, Peter Tchir of Academy Securities, with stocks coming off their best day in 6 weeks. Ed Al-Hussainy of Columbia Threadneedle on why AI may not have the impact on economic productivity that so many people think. And former senior White House trade advisor Kellyanne Shaw with fresh talks between the U.S. and China. We begin this hour with stocks edging lower as investors count down to retail earnings as well as data. Peter Tchir of Academy Securities writing, The end of free money has been a major factor in the recent downturn and could weigh on the economy and markets going forward. I think the economy is at a greater risk than we've seen in some time. Peter joins us now. Peter, great to see you.
Good to see you, too.
This seems to be echoing what we heard from Neil Dutta yesterday of Renaissance Macro, where he said that he thinks the train may have already left the station when it comes to Fed rate cuts and the potential damage that has been foisted upon the economy. Why are you so negative as well?
So what I'm seeing, I think, is what we're calling the end of free money, and kind of being a bit cavalier about that. But there was a time, right, if you announced you were spending X billion on data centers or AI, your stock went up 2X. And all of a sudden, now you're seeing people question that. You're seeing stories emerge about, which technology should we use? So I think we're going through this breather, right? A year ago at this time, if you didn't have an AI strategy, you were ridiculed as a CEO. Your stock was going to suffer. So there was spend. There was this kind of real rush to spend. Now I think everyone's sitting back, okay, what do we want to spend on? What is the best value? And the hyperscalers, right? All of a sudden, you can't just say you're going to build more and your stock goes up. So this is kind of this first time I think we might see a bit of an AI diet where people are like, okay, how do we be cautious on this? Where do we spend? What do we spend on? What technology is emerging? We haven't talked about anything out of China yet that could derail some of our stocks. So I think this is where we get a bit of a slowdown right now.
Before we get into the details of the AI trade, you said the end of free money. And I want to dive into that because yesterday we were talking about tightening liquidity conditions. Now, a lot of people attributed that to the sell-off that we saw in things like Bitcoin and also the big tech names. Why is this now the end of free money with the Federal Reserve cutting rates and ending quantitative tightening?
Well, you've also seen, coming back to some of the crypto, you had the DATCOs, or the digital asset treasury companies. Some are very sophisticated, some do a lot of things, some simply buy the underlying. And there was a period of time, right? If you bought X amount of Ether, your stock went up 2X. All of a sudden, that's not happening. So all these trades that were kind of self-perpetuating are falling down. And you're having a bit less liquidity come through this. And everything I hear and see when we're talking, whether it's consumers, corporate, I feel there's belt tightening going on everywhere. I think people are going to be a little bit surprised as they go through the budgeting process that companies are actually shrinking their budgets rather than growing, full scale.
What do you think the administration does in this? Because we were speaking with the Commerce Secretary yesterday who was beating the drum saying AI has been such a boon for our economy. David Sachs, the crypto czar, which also has an ear to the administration, was putting on X yesterday that it is an AI-related investment accounts that half of GDP and a reversal would risk recession. Is this an administration that would see the sector as too big to fail, as Sam Altman has hinted at to the chagrin of others at OpenAI?
What I think they are doing, and I think it's rightfully to do, is investing heavily in electricity and energy production, right? We are putting money into nuclear. We're putting money into everything that's really the bottleneck right now is this electricity. And supposedly that's one of the arguments with the TPUs versus the GPUs is lower electricity usage. So I think electricity is actually a bottleneck. I see the government spending a lot of time on that, which fits very much, I know you're sick of hearing it, but production for security or PROSEC. I think they are trying to figure out. I think these are the things that the government's trying to make sure goes along. I think it's going to be hard for them to intervene directly in AI. But yes, if we get this AI slowdown, unless other parts of the economy really pick up, we are going to see this potential, maybe not a recession, but a slowdown, and that's why I'm concerned.
How does the wealth effect play into that? Lisa's been talking about how just more of everyday people, of households own equities at this point, and a lot of the gains in equities have been tied to AI. If AI starts to take a breather, what overall wealth effect does that come back and have on the consumer?
Well, I think we've already seen a big hit to crypto, right? Bitcoin itself is down $650 billion, and it seems to track very well. I always use ARKK as a proxy for disruptive, stocks. Those stocks are down. So you've kind of seen this big move in certain segments of the market. Almost anything momentum related is down. So I think you've already seen a chunk of wealth wiped out for people who would spend that money. So I think we need to see this turnaround, or you're going to see everyone, hey, maybe we got to be a little bit cautious, right? We are everything's going to the moon. Crypto's going to 200,000, whatever the number is. All of a sudden you're sitting here at 86,000 on Bitcoin. I think it does create this negative wealth effect where people are going to be conservative coming into their spending.
So there are three ways to look at this. There's one way to look at it saying, okay, this is going to be a recession next year that no one's expecting, which is typically how it happens, which is what we heard from Neil Dutta. Then there's a way of saying that actually there's going to be a rebound early next year because of the tax refunds and other types of stimulative effort, but that there will be sort of this flagging growth. And then the third way of looking at this is it is going to be morally hazardous for either this administration or the Federal Reserve to allow this market to crater. So you're going to see this bazooka of stimulus coming from quantitative easing, from Fed rate cuts, and from fiscal that will ultimately propel this market higher. Where do you fall in?
I do think coming into the midterm elections, we are going to see a huge effort. I think Trump and Trump 1.0 learned the pain. If you don't win the midterms, it's really hard to govern your next 2 years. So I expect a lot of stimulus coming into that. And I have liked, for example, my favorite trade right now has been to be underweight NASDAQ 100, so QQQ in ETF form. And I like the S&P 500 equal weight. So RSP is one, ETF that you can use for that. And I think you're going to get this bit of a rebalancing, right? Some of the air is going to leak out of the AI. Some of it should be transferring to the rest of the economy. And that's why I like kind of the equal weighted S&P 500. I think as we take away investor focus from the AI to electricity, which is still going to be a part of this, but what else is going on in the economy? What else are we building? What are we making? We are going to be trying to build manufacturing plants. We're going to be trying to build mines. We're going to be trying to build refining and processing companies. So there will be activity, and I think that's the area that's going to shine next year.
If you are defensive, can you go into long-term bonds with the expectation that this is an incentivized Federal Reserve to ultimately bring down long-term costs in whatever type of financial engineering it requires?
Normally, I would say yes, but I'm kind of stuck more on the belly of the curve, 5 to 7 years. I just think there's going to be some outward pressure on the 10s and beyond as people are nervous. Did we cut too much? Are we being too aggressive? Are we paying attention to inflation? So I think that's going to diminish a bit of the rally there. So I kind of like the belly of the curve. I think you're going to see 2s, 10 spreads actually go potentially to 100. So I could see us down at 3% on Fed funds, and I could still see a 10-year close to 4%.
Are you getting those vibes from the Fed that they are going to be forceful in their cuts? We heard from Chris Waller yesterday saying yes, December, and then it's meeting by meeting.
I'll be slightly embarrassingly honest. I'm not really paying that much attention. I think we are going to get a new administration. The Fed's going to look very different next year. We're going to get to 3% before the middle of the summer. I don't really care whether it's a cut in December or not. That's kind of my base case, right? This is the direction we're headed. It's going to come almost hell or high water. So that's kind of how I'm thinking about it. I'm spending less attention to who's talking today and tomorrow. Look who's going to be talking in the future. We know we're getting these cuts next year.
I love it. It tells you something, Danny, when Peter Tchir is not keeping track of each Fed speaker. Maybe they have no clue and it's completely divided.
Also a great way to preserve your sanity, I think.
100%. So congratulations for being sane. Peter Tchir, the sane one, is going to be sticking with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Good morning, Lisa. Fighting between Russia and Ukraine continuing overnight with heavy Russian drone and missile attacks on Kyiv and Ukrainian assaults on southern Russia. The exchange is coming after President Trump suggested, quote, big progress was being made on a deal to end the fighting following weekend talks in Geneva. White House Press Secretary Caroline Leavitt says he still hopes the deal can get done by Thanksgiving. President Trump and his Chinese counterpart, Xi Jinping, held their first talk since agreeing last month to a tariff truce. Trump says the call was very good and touched on issues such as trade and Ukraine. He also says he will visit Beijing in April and that he invited Xi for a state visit next year. Shares of Google parent Alphabet rising in the pre-market on reports Meta is in talks to spend billions of dollars on the search giant's AI chips. The information reporting Meta plans to use Google's Tensor processing units, or TPUs, in data centers from 2027. An agreement would help establish TPUs as an alternative to NVIDIA's GPU chips. That's your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. All right, this is the time. Just 5 minutes.
Oh, wow.
5
okay.
seconds.
Thank you. I'm so
GPU
honored.
versus TPU.
Okay.
30
GPU,
seconds.
NVIDIA's chip, originally for graphics processing, so it takes a lot of energy and has a lot of broad applications. TPU, built by Google, very application specific, so more efficient, maybe a better chip, but people are already using a lot of NVIDIA chips, and there's a kind of locked-in thing to it, so it's hard to get to the other one.
This is the debate. More energy efficient, although more restrictive, or potentially more expensive, energy intensive, but flexible. The race is on. Up next, we're going to be talking about lowering the temperature with China.
It lasted about an hour, and it was a very positive call. The focus was mainly on the trade deal that we are working on with China and those relations and how they are moving in a positive direction.
Bloomberg's Michael Solner joins us next. This is Bloomberg Surveillance. Stocks just kind of meandering here, dipping just a touch after yesterday's surge, the biggest in 6 weeks for the S&P 500, the biggest two-day rally for the S&P and NASDAQ going back to May. Today, taking a little heat out of that, down about 0.1% for S&P futures, seeing yields just up marginally, but still lower than they were to start yesterday, 4.03%. Meanwhile, take a look at NVIDIA and Google, Alphabet in pre-market trading. A huge dispersion here in the fates of the two, and they're connected with Alphabet shares up 4.1% in pre-market trading. NVIDIA lower by 3.6% on that news that Alphabet might be gaining some clout in the TPU game. We'll get into that coming up. Under surveillance this morning, lowering the temperature with China.
I did speak with him about the call. It lasted about an hour, and it was a very positive call. The focus was mainly on the trade deal that we are working on with China and those relations and how they are moving in a positive direction. And the president and President Xi discussed continuing to stay in correspondence.
Here's the latest. President Trump saying his call with Chinese President Xi went well. The two leaders now planning in-person meetings next year. Bloomberg's Mika Solner joins us now. Mika, what was the understanding of what was discussed in that hour-long phone call between Xi and Trump?
Yeah, so the president and the Chinese president spoke for roughly an hour, largely focused on trade and trade negotiations, particularly around soybeans and how, China is impacting U.S. farmers as well. So that was a large focus of the call. But the two also touched on Ukraine-Russia war briefly. But I know that, there's been significant steps taken with the two promising to see each other in person next year.
Mika, the two readouts, whether it was from China or from the U.S., were vastly different. The one from the U.S. was talking about trade as well as a little smattering of Ukraine-Russia. The one from China really focused on Taiwan. Can you talk a little bit about that huge difference between the two readouts?
Yeah, I think that's really interesting, and I do think that there's going to be tension around Taiwan. I know that that's a big priority for the administration, but I also think that President Trump really wants to have a good relationship with China. I think that it's really different from previous administrations in the way that he negotiates with countries considered to be U.S. adversarial to the U.S. So there's going to be a lot going on and a lot of reaction from China hawks as well in terms of what's going to happen, particularly around Taiwan.
Mika Solner of Bloomberg, thank you so much for that. Peter Tchir of Academy Securities is still with us. Mr. Prosek, let's put that hat on, because ultimately this really does go down to what is your takeaway? Does this have more consequences potentially for Ukraine, Russia, or potentially for Taiwan?
I think probably more for Taiwan. So when we're looking at this, and again, I work with 30 retired generals and admirals, a couple CIA people, so we spend a lot of time on where this is all playing out. And I think as we're having conversation with clients, we're reminding, one, Xi said he wants his military to be ready by 2027. It's not a sign that he's going to do anything in 2027. But we've always thought what's going to happen is there's going to be a multiple application of the levers of power. So the levers of power are diplomacy, information, military, and economics. So the DIME framework. I think they're going to put so much pressure on Taiwan that Taiwan may eventually just say enough's enough. And we are seeing the U.S. pivot a little bit away from the kind of this global, policeman of the world to really focused on domestic, right? North-south, the Monroe Doctrine seems to be taking place again, right? We moved the Ford into the aircraft carrier into the Caribbean. So there's this big domestic focus. So I think there is some risk that Taiwan feels a little bit maybe left out, a little bit nervous. And when we look at trade negotiations right now, the two things that I think China has some power over us are still the processed and refined rare earths and critical minerals. So on PROSAC, I think we are trying to do a lot of that. I am convinced that this administration, from some talks as well, one, we want to produce the rare earths and critical minerals, but really we want to make sure we can process and refine them to break that lock that China has on us. We control the chips. We control the best quality chips. Again, maybe now we throw the TPUs into that. Those are things China wants. At the same time, China controls a little bit the ability for Taiwan to ship things. So far, China has not done anything, but they do have this very, very large maritime militia. They've used it in the past in little incidents, but they could put this to work. It's largely shipping vessels. They have larger vessels within that, and they would just disperse themselves in such a way that it would slow shipping down. They would throw logs off back. They would throw nets trying to foul propellers. So they could do a lot if they really wanted to push on us against Taiwan. So I don't know where this is all headed, but it feels a little bit parcel and parcel where we're focusing a little bit more north-south, Monroe Doctrine, and maybe China has a little bit more control in that region.
Where does that leave someone like Japan, who has been leaning on the U.S. alliance in their current heightened tensions with China after the prime minister made those off-the-cuff remarks that they would support or take action if China had military action against Taiwan?
I think it leaves everyone a little bit questioning, what is our mission, right? The Biden administration was very clear that we would support Taiwan. Trump has not been clear so far. And our official doctrine before Biden had always been ambiguity, right? So strategic ambiguity has been a part of this. The one thing, to me, it comes back, and we've been talking to clients about this for 4 years, and people used to kind of roll their eyes at us, and now I think they're listening, is shipping, you have to diversify your supply chains along shipping routes. You cannot be dependent on one shipping lane. So Thailand and Vietnam, you're not diversified. They're going through the same place, maybe even South Korea. So I think this is a kind of a huge wake-up call that everyone has to look at shipping as a bigger risk than we ever have in the past and say, hey, what happens if, and maybe it never happens, maybe we go on living peacefully and we have these great economic deals that allow it. I think we have to prepare for more and more deglobalization and more risk.
That's so interesting you say that, because I've had conversations with private equity executives who have companies, lots of them that need to deal with supply chain issues. And they've said, we've done such a good job since Trump came in as president because we've de-risked from China. And now we're in South Asia. To your point, we're in Vietnam. We're in these places that still might feel blowback should there be a larger scale conflict. Are there other options? Is the supply chain resilient enough to completely move away from that region, even if it's not China?
No, but I think you can diversify. You can have some there. You can have some other reasons, because you are going to want to try and sell into that region, right? India is a huge growth story. There's all sorts of opportunities. So you want to be there, but I think you want to look at South and Central America. What's going on there, right? Whatever happens, how do we do better with Brazil? So far, Brazil's been tough. We are working closely, I think, with Argentina. So I think there's going to be a lot of opportunities in that north-south. And again, keep coming back, and lots of things I've learned not being military, but, they talk about at Academy Securities the tyranny of distance. So in war, it is really hard to fight a war if you're far away. If you look at where Guam is relative to Taipei or Taiwan, it is a very far distance. It's going to be hard for us even when we try and do something to support that relative to what China. They have the same problem when you look at Central and South America. And let's not forget, the first place Marco Rubio went was the Panama Canal. That has never really happened in our history, right? The Secretary of Defense, Secretary almost always goes to the UK. He went to the Panama Canal. So there is something shifting in this administration. So I pay close attention to that. And if you want to be where the U.S. government's going to protect you and do the most, I think it's pretty clear to me you want to be edging or favoring North and Central and South America over Asia.
5 years ago, when the pandemic was raging, everyone was talking about the deglobalization and this idea that you had to build in sort of inefficiency in your supply chain to create redundancies. It was going to be inflationary. Now we're not talking about inflation. We're talking about disinflation from artificial intelligence, even as we see an acceleration of this trend of being more regional. Is there still an inflationary overlay to this that's the reverse of what globalization provided?
I think there is as it comes online. There is going to be some pressure on commodity prices. If we really start building these factories, if we build out the energy production that we need or electricity production, we are going to see levels of inflation that have been higher. I think it's persistent, say that 2.5% to 3.5%. It's not going to get out of control. But over time, we've also built a much more secure system. I think costs will go down over time, right? If you're not shipping things long ways. Again, I just keep coming back to, I really believe this kind of concept of production for security is going to replace kind of ESG. When we're thinking about sustainability, it's going to be much more like, what do we need at the base? And this is going to sound wonky, but, I look at Maslow's hierarchy of needs. I always think that's probably the most useful course I took was Psych 101. But it talks about you basically need shelter, you need food and all those things before you can move up to self-actualization. And we are kind of at the self-actualization. What we would like, I'd love to do this, I'd like to do these things. And then we realized we had our base eroded. We cannot produce the things that we need. How can you be safe or sustainable if you're not making some level of your basic necessities? So I think that's where we are headed. I think the government's the first to see it. I think capital is already starting to flow into it. So capital is going to be second. Corporations are going to adopt it. And I think Europe's going to start following. I think Europe's going to fight it a bit more tooth and nail. But ultimately, they're going to get dragged into this where you have to produce your basic necessities or some portion of it yourself and work with close allies, because you cannot just rely on China to be your friend.
Peter Tchir, thank you so much for being with us. Always really illuminating. Peter Tchir of Academy Securities, and this kind of goes to the heart of the issue. I remember a year ago when APEC was being held in Peru, and there was a real question over who is going to win the war right now. Is it going to be China or is it going to be the United States for one of the most important reserves of copper, of pretty much a ton of minerals that are absolutely essential to our modern world?
I remember when you were there, and the reporting you did was China is so present at this conference. They're present there. They're present in Africa. What does the U.S. do about that? To Peter's point, as they increase their reliance on those beneath us to the south of us.
There were Chinese flags. Xi came. He was going down the boulevard. Everything stopped. Real difference in tone. Coming up, we're going to be talking more about the emerging markets as well as artificial intelligence with Ed Al-Hussainy of Columbia Threadneedle, who thinks that maybe AI productivity gains are overstated. We are heading into the open about 3 hours away. Right now, what we see in the morning futures is lower across the board after the biggest one-day gain going back 6 weeks. NASDAQ leading the charge lower, down 0.3% despite the gains that we're seeing on the likes of Alphabet. What you are seeing yesterday was the biggest two-day pop for both the S&P and NASDAQ going back to May. Optimism around potentially Fed rate cuts. Take a look at 2s, 10s, and 30s. You do see a bit of that optimism fading, but definitely below where they were yesterday. 2-year yields getting a bid after we heard from Mary Daly that she was inclined to cut rates next month. She is not a voting member. Nonetheless, she tends to work with Jay Powell and tends to agree with him. John Williams also on deck for a cut. I am the one who's actually watching, Danny, and counting each of these. It looks like it's pretty evenly split right now with a lot of undecideds, and a lot of people are saying this is up to Jay Powell to decide whether or not this is a Fed cut or a Fed hold.
Which is why Mary Daly was so important, because to your point, she's very closely aligned with him. It's a very different environment. We've moved away from consensus building. And I also think interesting in that Mary Daly article, interview with the Journal, was she said, this is a good thing. This is a healthy thing. You don't want groupthink. The question will be whether that protects the Fed or exposes them in an era where you have a Trump pick at the top of the helm.
Yeah, and whether it gives any kind of guidance at a time where the guidance aspect is very much part of monetary policy transmission, which is a key question. Right now, we are 3 hours away from the cash open. Let's get some morning movers with Vonnie Quinn. Vonnie.
Well, Lisa, it is all about AI today, so let's take a look at these companies because you've been talking about it already this morning, TPUs versus GPUs. Remember, NVIDIA was great at making those graphics processing units. Well, now Meta is in talks, apparently, according to the information, to buy billions of dollars worth of TPUs from Google, the Alphabet company. Obviously, that could have an impact on NVIDIA going forward. Now, is this the very, very beginning of maybe what looks like the end of dominance for NVIDIA? Maybe, we'll see. But the shares are definitely suffering. Pre-market down 4%. AMD also along with it down 3.5%. And the Google parent up more than 4%. Let's switch it up because we are now looking at Alibaba. Just reporting this morning, we were talking about Qwen yesterday and the relaunch of all of its AI tools and its push into that. Its rivalry with Tencent and with Baidu, well, paying off apparently in the quarter. The ADR is up 4.5%. Overall revenue was up 5%, but its cloud intelligence revenue up 34%. Massive growth in that revenue in the quarter. And then let's take a look at SanDisk because you mightn't think of it. It's a memory chip company. We all remember carrying around those thumb drives and so on. But this is also really an AI story. This was bought by Western Digital back in 2016, spun out this February, up 530% year to date since it was spun out, up another 2% because it is now joining the S&P 500, and that's been giving the shares a boost. But obviously, there has to be an AI portion to this. It's in talks for the build out of large-scale data centers as well. So that's helping this memory chip maker today.
Thank you so much, Vonnie. On our radar this morning, tensions rising between China and Japan over the status of Taiwan. President Donald Trump holding back-to-back calls with the leaders of both countries. Any sign of the U.S. aligning with Japan could end up derailing its trade truce with China. Meanwhile, NVIDIA under pressure following a report that Meta is in talks to spend billions on Google's AI chips. Millions, billions, trillions. The information reporting Meta plans to use Google's tensor processing units in data centers beginning in 2027. And real quick, TPU versus GPU, Danny, it is...
I wish I brought my PowerPoint with me.
Yeah.
Okay, TPU is Google's chips. They're specifically designed to do the tasks of Google's cloud, so they're very efficient, both in terms of ability to get work done and energy, versus NVIDIA's GPUs, which were originally built as graphics processors, so they do more tasks, but a little bit more clunky, take up more energy. So you could say Google's better. The issue is there's a lot of locked-in syndrome. It's really hard to change cloud providers because so many people already use those types of data centers with NVIDIA chips. It makes it harder to transfer to Google.
There is this 1-2 punch, and it comes to something we were discussing yesterday with OpenAI and this question of whether Google could potentially supersede it in terms of Gemini 3 and some of its capabilities. This next story about NVIDIA versus Google and the idea of Google selling chips to Meta just reiterates this feeling of disruption and this ongoing sense that the story that we're seeing right now in AI is not the full story. It is not the end of the story. This is just the beginning, and we're not really seeing the full iteration.
And it's still a market, you'd have to argue, that hasn't decided who the winner is. You could do the Dan Ives thing. He's just put out a note with his top AI picks. It's kind of literally all of them. So that is one bet and one way you could do it. But if anything, it's a market that is more discerning. And again, I think Alphabet coming in as a challenger is so interesting because they have so many corporate relationships. They have better brand power than OpenAI does. So who's to say, if they can get people to switch over, that they're not going to be the ultimate winner?
Yeah, and just to add on to this, SoftBank shares tumbling to a 2.5-month low, with investor concerns really coming out after OpenAI with respect to potentially Alphabet's Gemini 3 superseding OpenAI, which is part of the reason why people are wondering, what is this iteration going to look like? Let's stick with AI. Ed Al-Hussainy of Columbia Threadneedle casting doubt on the so-called productivity boom, writing, AI will lead to an acceleration in automation, which has been a central feature of economic growth. AI will have no impact on aggregate economic productivity. Ed joins us now with that bold statement. Ed, why do you think that that's the case, given the fact that so many people are saying that is when this will start to pay off? That is when this will be disinflationary and not necessarily just the investment in nuts and bolts in the physical world?
Yeah, absolutely. Look, we've seen these waves before. The point I wanted to make is it's really difficult to translate technological innovation, which we've seen pretty much continuously over the course of the past 40 years, into aggregate economic productivity. That's extraordinarily difficult. It really requires us to reorganize how we make economic widgets.
So at this point, you're saying that there are implications for the fixed income world in terms of the ultimate payoff, right? Because it comes to not only the corporate debt market that's been fueling and funding a lot of this, but also it goes down to the expected inflation rate and just what kind of growth you can see on the heels of AI. So where do you think the biggest misunderstanding really is right now?
Yeah, I mean, part of the problem is we're channeling an extraordinary amount of savings now into the AI thematic. It's going to cannibalize, to some extent, the capital that's available to other parts of the economy, including the Treasury market. We're in the early stages of this. The AI theme has just come to the investment grade market wholesale. It will be with us for a number of years, no doubt. But one of the risks is it starts to lift yields across the board and starts to make the cost of capital more expensive for other companies. That ultimately could be a drag on growth down the line.
This is a real crowding out, because not only in capital, but in manufacturing capacity, the way that energy is used too. So wouldn't that be a healthy thing if all of a sudden we've decided we've gone too far and AI backs up and the spending on AI backs up? Does that open up other parts of the economy to make use of this capital, make use of the energy, make use of America's manufacturing capacity?
Yeah, eventually that could very well be the story. We've seen this happen in other parts of the world. China is a fantastic example of this. It's gone too far. We're now seeing deflation, outright deflation, because of that capacity in China. It's very early in the story, but one of the risks is we've invested an extraordinary amount of capital, some starting with a T at this point, in the AI thematic, and some of that capital either depreciates rapidly or is stranded and doesn't contribute to economic growth.
What happens to private asset players who've all started to pour money in this? A lot of the conversation there is, we're not taking AI risk, we're taking meta risk, we're taking Oracle credit risk. If what you're talking about, that corporate bond markets also start to feel some of the pain, what does that do to this entire ecosystem of funding?
Yeah, it's quite vulnerable. Let me say this, the good news is we're starting with corporate balance sheets that are extraordinarily strong. These are high quality, high grade issuers. The corporate bond market, particularly the investment grade market, was practically invented for this. It's there to fund these themes. So it's going to be a while until we get to a point where it starts to degrade and we see whether it has an impact on earnings. But the fact that the story is so deeply interconnected is definitely a vulnerability. That's not a new theme, but it's going to be with us for some time.
So how much of a liability do you think this is for the Treasury market?
A little bit. And again, the good news is we're sort of focused on the narcissism of small differences. What is the Fed going to do in a couple of weeks? The AI theme doesn't affect that in any meaningful way. One of the core questions for the Fed in the next couple of years is, should we assume, the way Greenspan did in the mid-90s, that productivity is rising? That's a license to keep monetary policy tighter than it would have been otherwise. If they make a mistake, and look, Greenspan got lucky and he got it right, but if we make a mistake, that leads to lower growth, that leads to tighter policy, that leads to lower inflation in the coming years. And that's going to be a really, really interesting debate in both 2026 and beyond.
If this does lead to greater weakness and potentially overly tight financial conditions, at least for the rest of America or the rest of corporate America that hasn't experienced the AI boom, are you expecting this to be essentially disinflationary for the wrong reasons, right? The idea that it could actually slow growth and end up in a situation where the corporate debt issuance really suffers because the growth just isn't there to really fuel the returns and the profits in an ongoing way?
Yeah, let me start with the second part of the question. So if productivity does not materialize, or in other words, productivity is very concentrated in parts of the economy that potentially deliver earnings to these companies, it's fine. If productivity becomes more diffuse and the economy as a whole starts to lift, that's a license for, again, higher interest rates across the board. That's a license for a healthier growth story. That's something we saw in the mid-90s through the mid-2000s. Great outcomes in terms of inflation, fiscal, interest rate stability, and so on. The challenge for the Fed is, again, if we make the wrong assumption in the short term and we put that higher productivity story into our strategy at the moment, you could make a much stronger case for tighter policy, and that would be a mistake at this stage.
So if that's the case, what's your highest conviction right now heading into year end, into 2026?
With respect to interest rates, look, I think we have a starting level of real yields, inflation-adjusted yields across the board that are still quite healthy. At the same time, when you look at the corporate debt market, where we're financing and underwriting this AI story, corporate spreads are extraordinarily tight. There's a lot more room for those spreads to widen, and there's a lot more room for real interest rate, inflation-adjusted yields to come down in the course of the next 12 to 18 months.
What would it take for spreads to widen, though? Because this is a market that's flush with cash, looking to put it to work. And it feels like every single auction, every single debt issuance, that there is so much demand that spreads, even when they widen, are widening to 70 basis, nothing crazy still, even when you do see widening.
Absolutely. And the appropriate answer is, I have no idea. All I know is, at the moment, investors are not being compensated for a lot of the risks that they are taking, particularly in weaker balance sheets. How quickly those balance sheets degrade ultimately is going to be the key part of that narrative for next year. And then most importantly, we need a shock to our beliefs. That's what always happens. There are deep stories that are embedded in the way we price these spreads. There are deep stories around the AI thematic, for example, that are being embedded in how we price assets in the economy. Shocks to stories like that ultimately are what reorient credit spreads.
I think that we've had enough shocks for this year, but we could have more, and that's what Al-Hussainy of Columbia Threadneedle is laying at. And thank you so much for being with us. Have a wonderful Thanksgiving. Right now, let's get you an update on stories else for this morning. Here's your Bloomberg Brief, the Vonnie Quinn. Vonnie.
Lisa, thank you. UK Chancellor Rachel Reeves is getting ready to deliver her autumn budget tomorrow. Sources telling us here at Bloomberg she will announce plans to slash the amount Britons can save in their tax-free cash ISAs each year by nearly $16,000. The decision is part of Reeves' push to get households to invest more in UK stocks. Apollo Global Management CEO Mark Rowan saying people have, quote, lost their minds over private credit fears. Rowan rejecting the notion that adding private assets to retirement and insurance portfolios could pose a systemic risk. According to the Apollo executive, most private credit held by insurers and by pension fund buyers is rated investment grade. Rare layoffs taking place at Apple. Sources telling us here at Bloomberg the iPhone maker has eliminated dozens of roles in its sales organization in a bid to streamline the way it offers products to businesses. The affected positions include account managers and staff who operate Apple's briefing centers and product demonstrations. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, looking for the edge in trade talks.
I think the question that we are negotiating is how to do things bigger and better together between our two great economies.
Former senior White House trade advisor Kellyanne Shaw joining us next. This is Bloomberg Surveillance. Good morning. Less than 3 hours away from the opening bell, you can see a little bit of a rebound from the earlier lows in futures. Futures softer across the board, down about 0.2% for S&P. But you can see a bit of just sort of meandering after yesterday's rally. Yields marginally higher on the long end, lower on the front end, 4.03% on the 10-year. Take a look at these retail names. We are getting some earnings this morning. We're getting Kohl's, Dick's, Best Buy, Abercrombie & Fitch, Dell, HP. Just moments ago, we got Burlington Stores, which is a discounted retailer. And Danny, it did seem to be a beat, which is, again, sort of this interesting question of, is a beat on some of these discount retailers a good thing for the U.S. consumer, or one that potentially belies a little bit of concern and choicefulness, as the word of the day seems to be?
You add that, and then you add Walmart doing better, getting higher income consumers coming down. Maybe it's not a great thing, but I have to say expectations clearly were very high for Burlington. Shares are down very sharply, and I wonder if it has to do not with what they're saying are great trends, but the fact that their third quarter comp sales were much less than expected, about half the rate that they expected. Maybe they didn't raise things enough. So it's one of these companies that people are like, yeah, you're a discounter. We know you're doing well. And if you don't show up and raise things more than you have, we're going to punish you.
Yeah, revenue missing. They did say that traffic to our stores fell off significantly after the back to school period, driven by unseasonably warm temperatures in our major markets. This comes after some discussion over hurricane season when it comes to the Lowe's and the Home Depots of the world. We'll be watching out for other retailer earnings, just as a forward-looking read on what we might expect during this holiday season. Under surveillance this morning, looking for the edge in trade talks.
I think the question that we are negotiating is how to make the deal bigger, how to make it stronger, how to make it more inclusive, how to bring in these digital Markets Act and try to improve that for digital America, how to maybe do steel and aluminum and how to include that, how to do things bigger and better together between our two great economies.
Here's the latest. Talks underway to preserve trade deals reached earlier this year. Former senior White House trade advisor Kellyanne Shaw writing, the détente between the U.S. and China is continuing to hold, and I expect it to through New Year's. I am increasingly skeptical about the durability of the U.S.-EU trade deal. Kellyanne joins us now. Thank you so much for being with us, Kellyanne. Let's just first talk about what you make of the idea of negotiating a deal for the EU and the U.S. that supposedly was already set in stone.
Yeah. Good morning. Thanks so much for having me on. This is why I'm so skeptical about this deal and frankly watching it very, very closely. The United States and Europe announced back in July that they had agreed on a package of mutual concessions, including tariff cuts going both ways. The U.S. implemented that going all the way back to August 1st. The EU has only introduced its legislation with no real hope of even passing it in the short term. So the EU has yet to cut a single tariff line. Now, the U.S. is in Brussels. You have Ambassador Greer as well as Secretary Letnick, who are there talking to their counterparts. What seems to be on the table is a potential deal on steel in exchange for concessions on the digital single market, on the DMA, on some of these digital regulations. But the EU has said that they're not budging on that. So I don't expect the U.S. to budge on steel and aluminum either, which means we have an impasse. And I think as soon as the president starts to connect with the fact that the EU hasn't cut a single tariff line, that's going to spell some serious trouble for this relationship.
That relationship has been frayed for quite a while. There are ongoing questions also about the U.S. and China. And I think that right now more people are focused on that just simply because of how essential trade is between these two economies, particularly when it comes to rare earth minerals and a couple other products. I'm just wondering what you make of the phone call between President Trump and President Xi and this idea of a visit coming in April.
Yeah, this was a really interesting conversation. It wasn't interesting so far as the two leaders spoke. They speak all the time. It's not unusual to follow up with a successful meeting and a deal that is being implemented to touch base, to talk about the trade issues, to talk about China's soybean purchases, wheat purchases, and other commitments that are coming due. But what I found so interesting were the competing readouts, and one in which China really rushed to get out. The president didn't even give his own readout for several hours later. China's was almost exclusively focused on this issue of Taiwan, on the importance of Taiwan, saying the U.S. had acknowledged the importance, talking about its criticality for the post-world international order, while the U.S. readout didn't mention Taiwan at all. It was focused on the trade deal, focused on Ukraine. And so it's this he said, she said, what actually happened in this call mystery. Now, of course, there are no transcripts available to the public about what happens in these behind-the-scene phone calls. But what is interesting is the narrative that both sides are laying out. And I think what is clear is what's on China's mind right now. I think the president's focused on this trade deal. But when the president does go visit President Xi in April, I have no doubt that Taiwan is likely to be on the agenda, at least from China's perspective.
The fact that Taiwan wasn't mentioned by President Trump, Kellyanne, does that say anything about the White House's willingness to step in should there be military action from China to Taiwan?
I certainly wouldn't read that into an omission. I think from the U.S. perspective, this call was really about checking in on the trade deal, discussions around what's happening in Ukraine. The administration has said several times over the past few months that there's no end to the Ukraine-Russia war without China's active participation. So I do think that those are the things that are likely on the administration's mind right now. I think what is clear based on what is happening between China and Japan right now, the concern over Taiwan is really this messaging campaign that we're seeing from China. This seemed to me more about a race to win the narrative versus what actually happened in the call. And I think that's why you're seeing the U.S. just not address it.
I was going to say, in terms of competing narratives, you also had the Japanese prime minister say that she received a call right after that China-U.S. call from the president. But we didn't really hear about it from the side of the U.S. Kellyanne, what do you make of that?
Yeah, clearly there is a tremendous amount of tension right now between Japan and China. China's threatening to cut flights. There is a huge diplomatic row right now over the prime minister's comments about the existential threat to Japan of any sort of military incursion by China into Taiwan. I think what the United States president is showing is solidarity with the prime minister. I think this is about saying that we are with you, we stand with our ally. I don't think the president needed to issue any sort of statement to make that point. The fact that that phone call happened was the message. And so I do think that the United States and Japan are united. But again, this issue of Taiwan is increasingly on President Xi's mind. And I think this will be a real point of tension, particularly going into those April meetings. And I expect President Xi to try to squeeze the president for something on Taiwan. And that's when we'll see what the U.S.'s real position is here.
Kellyanne, how much is it a tit for tat, this idea that if the U.S. does shift away from hardcore rhetoric around Taiwan, that China will help with the Russia-Ukraine war and potentially bringing an end to it sooner?
Look, I think that China is likely to use all of its leverage points in terms of trying to push issues that are so important to it. And Taiwan is issue number one in terms of the things that President Xi wants to do. But look, I do think that the U.S. position is strategic ambiguity. I don't think that the fact that the president hasn't departed from that, or at least said anything from that, indicates a different pivot point in U.S. policy. But again, the rubber is really going to meet the road come April, when I fully expect President Xi to push the president on this issue. And then again, we'll see what the result is. But the U.S. position, as far as I'm aware, has not changed. I think strategic ambiguity continues to be the U.S. view.
Former senior White House trade advisor Kellyanne Shaw, thank you so much for being with us. Definitely the two different readouts were notable, given the idea that people were wondering, what exactly is this phone call and what exactly will this meeting be in April?
Right. And what did President Trump say about Taiwan? What was his response? Because the Chinese angle was very clear. To them, it's a matter of sovereignty. And for the White House's response, just question marks at this point.
Yeah, and question marks around AI and just how much the U.S. was willing to sell chips into China. Coming up next, John Bilton of JPMorgan Asset Management, Jeannette Lowe of Strategas, Lauren Murphy of Wells Fargo, and Samantha Dart of Goldman Sachs as we get retail earnings, as we parse through the day ahead with Google very much front in focus.
What I am a little bit worried about is that the Fed is kind of dragging its feet.
It's sort of confusing what you're hearing out of the Federal Reserve.
You might not want to hold the Fed to the same standard as in normal times.
It's certainly a much more rowdy and disorderly process from the Fed than what we're accustomed to.
We will get 3 rate cuts over the next 12 months, but December's still a toss-up.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks meandering after the biggest two-day pop since May, taking some heat out of that today in futures. Retail sales trickling out for the likes of Burlington earlier, Kohl's and Dick's Sporting Goods as the holiday shopping season kicks off, with traders awaiting September retail sales data in about 90 minutes' time. And Alphabet becoming the U.S.'s third most valuable company, approaching $4 trillion in market capitalization as it presents stiff competition to both OpenAI and NVIDIA. Danny, this question of disruption very much roiling the artificial intelligence space.
It does. There is so much churn underneath the surface as the market hasn't fully decided on who's the winner. We're going from the yay, everybody's a winner that does anything with AI and spends money to, hey, maybe not everybody is going to be okay. But one of the interesting things is, despite how volatile that sort of back and forth has been, it is the Fed that's dictating the overall directions of markets. It was yesterday in hopes of a cut that was lifting us up. Weeks before, it was doubts of a cut that was pushing us down.
Yeah, and this is really going to the bifurcation that you're seeing in the market. So even though we did just see the biggest two-day pop going back to May, there was, again, that bifurcation, this tale of two halves within the market, with about half the market not participating. The consumer-facing stocks not exactly rallying. You saw, for example, Carnival shares falling quite considerably. And it goes to this question, how long can the AI trade continue unless you get participation of the rest of the economy? And is the Fed too late to turn around the weakness that we've seen in certain pockets, akin to what we were hearing yesterday from Neil Dutta?
I also think that's why what Al-Hussainy told us from Threadneedle was so interesting, because the idea that a productivity boom is going to come to the rest of this market and to save us, even if AI spending slows, he cast doubt on that. And that's a real problem for those that say, yes, the AI trade, but all these other companies are benefiting from it too. What happens if they don't? And what happens if that happens at the same time of a slowing consumer?
Meanwhile, this is the shopping season, and that's the reason why the retail earnings have been so interesting. We saw from Burlington, they did raise their full year forecast, still taking a beating on comp sales. Kohl's, just take a look at that, jumping 15% after their comp sales beat estimates in the third quarter. This is a company that just had a new CEO come in, but those shares really rallying after seeing full year operating margin significantly above where it previously expected, and just beats pretty much across the board, Danny. This to me is really interesting.
It is fascinating. And the margin story, which you just pointed to, again, this is a sector that we assumed margins would be really bad. We assumed that they'd be paying more and they'd have to move it along to the consumer. That's not what's playing out. They're finding clearly efficiencies from somewhere else. And for a company like Kohl's that has been in such need of a turnaround plan, the idea that they're able to do it in this environment with a new CEO at the helm, again, is getting greatly rewarded by this market.
The word efficiency keeps coming back to that, and we will keep looking at that. Right now, the efficiency in market is just slightly lower after yesterday's rally. You're seeing equity futures lower by about, it was 0.2%, reprising some of that as we do get some of these earnings now basically unchanged. We are seeing unchanged on the 10-year. Wow, this is not a very active board today. Coming up this hour, John Bilton of JPMorgan Asset Management, as investors maybe tap the brakes, maybe just take a pre-Thanksgiving pause. Jeannette Lowe of Strategas as Ukraine peace talks gain momentum, and Samantha Dart of Goldman Sachs on why energy is the key to winning the AI race. We begin this hour with stocks sort of meandering following yesterday's tech-fueled rally. John Bilton of JPMorgan Asset Management seeing potential for positive returns, writing, the recent pullback is presenting a buying opportunity, and we feel the gloomy narrative on tech is somewhat overdone. John joins us now. John, thank you so much for being here. I could use a little bit of excitement and optimism this morning. I'm wondering why you think that any kind of rally is going to come on the heels of people watching the AI space and gaining enthusiasm about it again, rather than focusing on the transformation and the competitive landscape that we're seeing, certainly on a morning like this one.
Well, I think we've got to remember what tech actually is. It's about innovation. It's about the next new idea, and it's about continually challenging itself. Think back to, I think it was February time, when, of course, we had DeepSeek suddenly appeared on the horizon, and I thought, oh my goodness, what does this mean for US tech? You know, it's all over. Was it? Absolutely not. We got the strongest rally out of tech that we've seen in an awfully long time from April onwards. So I think what we're beginning to see is something of a maturation. We're seeing competition begin to come in. You know, we're seeing different opportunities using different technologies for different purposes, etc. There's a lot of money going in. This year's or this third quarter's results from the tech leaders show huge capital spending commitments, which will continue to boost the investment share. Open question on productivity. Longer term, you know, we've looked at this in our long-term capital market assumptions work. We do feel that productivity is set to gain, but it's a long burn. it requires the investment first. And so we think that there's reasons to be positive, and we think that with this cycle of investment happening now, there's reasons that we will see dips bought.
Is there enough cash and enough investor enthusiasm to supersede any kind of hiccup that would come from, say, just theoretically, a company that's worth about $500 billion and is private, that has a lot of loans, that's sort of trying to grow into the image that it has for itself, OpenAI? If you do get some sort of blow up of one of these companies that has been more speculative?
Well, look, take a step back from the individual companies themselves. There's a lot of capital in motion right now. There will probably be winners and losers out of that. I'm not a stock analyst. I wouldn't want to project as to who's who. But with the amount of capital being spent, we know that up to around 80% of total factor productivity gains typically can be explained by the upfront investment. Bigger issue we have right now, actually, again, if we take the long view, we know that the input of labour into growth going forward is going to shrink. We've got bipartisan support for clamping down on migration, and it's a global factor, by the way. It's not just a US thing. So it amplifies the impact of an ageing population. So as my colleague Dr. Kelly likes to say, someone who I know is on this show quite a lot, productivity is what happens when you run out of workers. And guess what? So we are constructive there, but we're tracking a chain of events from the investment being made to the technology being built, to the adoption taking place and then the full deployment. No prior tech cycle, mainframe, e-commerce, mobile telephony, and now AI, has not gradually broadened out through time. So we are optimistic about the overall technology cycle here, and still in the early stages, we think.
It's incredibly complicated, though, and I was joking with Lisa earlier that, I, for some reason, spent a huge chunk of my day yesterday understanding the differences between TPUs and GPUs. You say you're not a stock analyst, and you're certainly not a tech-specific one at that, but is there a sort of sense that in order to be an active investor, in order to actually understand who are the winners and losers, you need to have a technical know-how that most people don't have? Does it pay to be hyper-specialized on tech in this kind of environment?
Well, I think the same is true on any sector. If you get down into the depths, if you don't know the difference between an oncology drug and a therapeutic, you're not going to be a very good pharmaceutical analyst.
But this is a sector that dominates the market, though, whereas you can't say the same for pharma.
But fair point. But if we think about it, you can break it down into the jobs that tech is doing. Highly specialized functions need that real top-end, cutting-edge innovation. That's where your GPUs are coming in. Your TPUs, which are much more, brute force, can apply a lot of processing power to a more single direction. I think the ability to be able to scale and learn fast about what one is investing in. Actually, funny enough, if you think about it, that's an amazing AI use case. So I think what we can see is how we stratify different uses of AI. Are we automating simple tasks? Are we doing large model, sort of modeling of very unstructured data? Those are two different endpoints. But just having that basic understanding of what's leading where, I think, is reasonable as a financial analyst anyways.
To that point, there was the dream of agentic AI and superintelligence, and it's something that Sam Altman talked about, Jensen Huang, and it's a thing that really built up stocks and had this, I don't know if you want to call it bubble, but anyway, high valuations because of this far promise in the future. Has something changed? Have we decided that we care less about what's happening in the future and more about the here and the now in terms of profitability and actual use cases of AI?
Well, I think there's a little bit of both, really, because I think that we always want innovation. It's one of the reasons why we continue to see that the US carries on dominating global market capitalization, even out 10 to 15 years from now, when we look at the work we've done in our capital market assumptions. So that innovation cycle is incredibly important. But at the same time, this is what separates in our mind from the dot-com era to where we are now. We've got high-quality, cash flow generative companies making investments that actually have real-world gains. And once more, I'd come back to that point. Productivity is what happens when you run out of workers. And that's the biggest driver to us. It's not the robots coming for our jobs. It's the fact that there are fewer of us. And we still want to be able to sort of develop processes and growth around that.
This is the reason why people are having such a hard time getting a handle on what exactly is going on with the economy during this transformation that has a very different kind of time frame. We're going to be getting ADP payrolls numbers coming up on their weekly at 8:15. At 8:30, we're going to get backdated, stale data from September. We are getting details from some of the retailers who are reporting earnings today. I'm not going to have you comment on them because I know you're not a single stock analyst, but it's been generally a positive read. It hasn't been gloom and doom, and yet what we're hearing from a lot of people is that there is a lot of gloom and doom, and you are seeing that in the bifurcation of market performance. Do you think that is overstated in the non-tech names or not tech obvious names, the idea that the consumer really is a lot weaker than it might seem?
Well, I think there are differences in the consumer as you look across income cohort, for instance, but we know that the dominant piece of retail sales of any sort of activity in the consumer space is driven by the upper income brackets. Where we will get some impact, though, of course, and this is the delayed impact of the Fed, will be on gradually lowering those costs for consumers across the board. We're also seeing oil prices reasonably stable, which is great for households at the end of the day. These operate with a lag. Right now, if we had a very exuberant consumer, I'd feel much more concerned about the outlook for the economy. When you've got the consumer, when you've got consumer sentiment really, really weak. In Europe, 15.3% household savings rate. It's the highest we've seen outside of the pandemic. The consumer has actually a surprising amount of coiled up sentiment and coiled up savings as we look around the globe more generally to put to work. We get big issues, a thawing between Washington and Beijing, as we've seen a little bit of. Possibly, and we hope, perhaps steps towards peace between Russia and Ukraine. As we get some of these big sort of geopolitical overhangs working their way through, the potential for a pickup in sentiment could be quite powerful from the consumer's perspective.
And a lot of retailers are trying to get ahead of that and build up their portfolios. John Bilton, thank you so much for being with us. Have a wonderful Thanksgiving, if you celebrate. John Bilton of JPMorgan Asset Management. And we are seeing certainly coal shares absolutely surging now, up more than 20% after those earnings. But what you can see across all of the earnings is a tale of different corporate execution. And this question of efficiency, this question of market share, this question of which goods they can actually raise prices on. And Danny, to me, that's the reason why it is so hard to get a more macro read from some of these micro earning reports versus just corporate strategy to adapt and adjust.
It's such a good point because you've seen it all throughout earnings season. Does the fact that all of a sudden the fast casual restaurants are doing really poorly, does that mean everybody is doing poorly, but TJ Maxx is doing well, Kohl's is doing well, Walmart is doing well? Is that a good thing or a bad thing? It is a choose your own adventure, depending on what company you pick and what narrative you want to build around it.
Just give more protein. That's, I think, what we've learned. Anyway, we'll get into that, or we won't get into that. Let's get to an update on stories elsewhere this morning. Here's your Bloomberg Brief with Vonnie. Vonnie, thanks so much.
Lisa, thank you. Tensions rising between China and Japan over the status of Taiwan. President Donald Trump holding back-to-back phone calls with the leaders of both countries. China's foreign ministry saying the U.S. initiated the hour-long call with President Xi Jinping. Trump then called Japan's prime minister to reaffirm their ties. Any sign that the U.S. is siding with Japan on Taiwan could jeopardize its trade truce with China. A federal judge has thrown out the criminal charges against former FBI Director James Comey and New York Attorney General Letitia James. The judge ruling the prosecutor who brought the cases had been illegally appointed. And nearly 2 years after the mid-air calamity that plunged Boeing into crisis, the company says it's making progress in its war against defects at its 737 jet plant factory. The company's efforts include weekly meetings where employees discuss on-the-job impediments and irritants. Boeing says it's seen encouraging results and is planning to increase 737 output to 60 jets a month. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, bringing the war to a close.
The idea that the United States of America is not engaging with both sides equally in this war to bring it to an end is a complete and total fallacy. That could not be further from the truth.
Jeannette Lowe of Strategas joins us next. This is Bloomberg Surveillance. Less than an hour till ADP Tuesday. It kind of doesn't have the same kind of ring, and yet we are going to get ADP payrolls data coming out at 8:15 that might give us a little bit of a current look at the underlying economy. Right now, stocks doing nothing. Futures basically unchanged. On the S&P, we're tracing losses from earlier this morning. We are seeing 10-year yields marginally higher, but lower versus where they were this time yesterday, 4.03%, and crude just off by about 0.4%. Under surveillance this morning, bringing the war to a close.
The idea that the United States of America is not engaging with both sides equally in this war to bring it to an end is a complete and total fallacy. That could not be further from the truth. I have watched as the president and his team have worked around the clock overnight with both sides on endless phone calls, endless meetings to try to bring this war to a close.
Here's the latest. Peace talks between Russia and Ukraine gaining momentum. Sources telling us here at Bloomberg, a U.S. official is meeting a Russian delegation in Abu Dhabi ahead of President Trump's Thanksgiving deadline. Bloomberg's Mika Solner joins us now. Mika, what's your sense of where we are? It's gotten from a 28-point now to a 19-point. How close are we actually getting to some resolution in this push for a peace negotiation?
Well, the White House is very adamant to bringing this war to an end, but they have softened that Thanksgiving Day deadline, which is obviously just a couple of days away. But I know that, that they're really trying to stress and emphasize. We just heard White House Press Secretary Caroline Leavitt say that they're negotiating strongly with both sides. Now, this is to say the White House is also facing some criticism, saying that they're playing too much into what Russia wants. So we're going to see what they're doing there, and they're trying to work out those kinks now.
Mika, do we have a sense of what Europe's role is in trying to negotiate this and get back on the stage when it comes to trying to understand what the discussions are, who's having discussions with whom?
Yeah, I think that the White House says that they're working very closely, trying to keep everybody in communication. I know that there is a consensus that everybody wants this war to end, and I think that the U.S. is working strongly with European allies in terms of rebuilding Ukraine. But right now, they're still negotiating out a lot of this. The deal keeps changing and shifting. And so we're really going to see what comes. But I know that these talks are ongoing, and the administration believes it's making strong progress here.
Mika Solner, thank you so much for being with us. Jeannette Lowe of Strategas writing, it remains a question as to whether negotiated changes can hold and if Putin will agree to the ultimate plan. Jeannette joins us now. Jeannette, what do we know about what's been taken out of the initial 28 points that could potentially bring Ukraine closer to agreeing to this?
So, there's a couple of things that definitely started to push things a little bit more towards Ukraine's favor versus Russia's favor. That would be things like allowing Ukraine's military to be larger than it was under the 28-point plan, the potential for it to still be allowed to enter into NATO at some point if there is agreement, to allow NATO troops to be in Ukraine, but not on a permanent basis. So those were some things that allows Ukraine to have a little bit more stability with regards to its military, but then also having more security guarantees longer term. So we'll see if that holds. I think one of the issues has always been whether or not Putin really will agree to a deal. He came to the Alaska summit, made it seem like there was going to be progress made with President Trump, and then basically the talks went nowhere. So I think that remains to be seen. We hadn't seen Putin specifically say that this would be something he would agree to, even when it was the original 28-point plan, whereas there was much more pressure on Ukraine to actually agree, and it was left to kind of see then what would happen with Putin on the other side.
Given that after this, or as this negotiation has been going on, we had the call yesterday between Presidents Trump and Xi. What role will China play in this? Do you think that they will be able to exert pressure on Russia to accept any sort of deal?
It's interesting because I think one of the things that we've been watching too is what's been happening in Venezuela, and could that be an effort to try to put more pressure on Russia to accept a deal? I think there could be some pressure with regards to China to try to get them to get Russia to accept a deal as well. It also could be just China watching what's happening. Maybe they hadn't been involved in these discussions and wanting to make sure that they were at the table and kind of seeing what might be at play with Ukraine and thinking that there might be some similar tactic that might be taken with regards to Taiwan, since that obviously was a piece of the conversation that they held yesterday. But I do think Trump is really trying to push Russia to get to a deal. We'll have to see if that ultimately is successful, but he does want the war to end. He does kind of want lower oil prices, getting that geopolitical premium out of the oil prices. He probably also wants to separate Russia and China and having some those linkages during the war, breaking those apart a little bit, as he is trying to really remove the strength of China overall, kind of also focusing on decoupling the U.S. from China. All of those things are coming into play here. So I do think that ultimately it was probably more still about trade, and Taiwan and issues with Japan at this point, and maybe even less so about Ukraine.
I was going to say, when it comes to trade, does it make any difference that these Ukrainian negotiations are happening at the same time that you have Trade Representative Jamieson Greer and U.S. Commerce Secretary Howard Lutnick in Brussels trying to negotiate yet again with the Europeans on trade deals with the U.S.?
Yeah, I mean, it was obviously interesting that the Europeans were a little bit caught off guard by the original 28-point plan. So things are also within the administration kind of focused on very separate tracks at the same time. Things are definitely in their own lane, and then they do have spillover effects. But obviously, this has been something with regards to the EU and the US that there has been a little bit of tension with the Europeans thinking that with the steel and aluminum derivative products and things like that nature, that it seems like the 15% tariff rate that they've ultimately had is not going to hold and is not going to be as beneficial to them. They're obviously also looking for other tariff exemptions, thinking about things like wine and spirits and pasta. So there's also that very separate thing. But I think those I would probably tease apart. I think this is much more focused on there was the effort in Gaza that was relatively successful. The administration wanted to take that momentum and put it towards getting some sort of deal with regards to Ukraine. And there's obviously this piece about trying to put a little bit more pressure on Russia with regards to oil, with Venezuela. And I think now there's just trying to see if we can actually get to a deal. But I do think Putin is probably the bigger question mark here.
There's a potpourri of issues here, and I'm trying to parse out how much is cost of living issues, how much is some sort of domestic win to celebrate international victories, and how much is an effort to work with allies and really get some sort of understanding that can hold. How much of it do you think is a cost of living issue that makes the U.S. more amenable to potentially lowering tariffs or being more cordial in some of the discussions in order to at least lower anything that people pay back home?
Yeah, I mean, I think the one thing here is that the oil piece, even before this affordability issue has really kind of come to the fore over the past few months, the oil premium that, him trying to say, I want to end wars, I want to lower oil prices. This was something that Trump pointed out early on in his administration before he came in, and then early on in the beginning weeks and months. So this has always kind of been his goal here. So I think this is less about affordability and more about getting the war ended, but still having lower oil prices. The tariff exemptions, obviously, to some extent, were about lowering prices, but the administration had also flagged this early on. You've always had Secretary Lutnick talking about the fact that the U.S. doesn't grow mangoes and that we'll probably have to exempt goods like that from the tariffs. So that is where we have ultimately ended up. Of course, it's happened as the conversations about affordability have really grown. So there is that component to it. But the fact that they decided to make the exemptions across the world for all of those goods. But even if you get some additional exemptions, let's say with Europe, and there's a cost coming down in some of those things, it's really not significantly large. We looked through all the tariff exemptions that came out, and it only really reduced tariffs on an aggregate basis by $7 billion. And we still have nearly $380 billion worth of tariffs in place. So it's really not going to lower overall prices. It's really much more targeted at specific food items and that affordability aspect.
Jeannette Lowe of Strategas, thank you so much. Currently, affordability very much front focused during the retail season, and we've heard from some retailers about how they're handling it. A real motley picture here. I got to say, Danny, I mean, you look at the performance of these shares after they report earnings, and it's, again, choose your own adventure. It seems like everything is, as you were saying earlier, with some really delivering and some talking about efficiencies, Dick's potentially closing some Foot Locker stores.
And they're saying that even though they've boosted their outlook for a second quarter, and shares are being punished because everybody's looking for cracks, and the fact that they might need to turn to efficiencies, maybe that's a crack for Dick's Sporting Goods.
And this is the reason why so many people say this idea that AI made us cut jobs isn't really the story. It's actually we're just looking to cut money, to cut costs and preserve our margins. Coming up next, we'll be talking about that with Lauren Murphy of Wells Fargo as holiday shopping offers a fresh read on the consumer. This is Bloomberg Surveillance. About 2 hours away from the opening bell, and you can see futures just trying to find some kind of direction after being down as much as 0.2% on the S&P, now essentially flat. Even NASDAQ futures have really retraced. Yesterday was the biggest one-day pop going back 6 weeks, biggest two-day pop for both the S&P and the NASDAQ going back to May. The Russell 2000 turning around up to 0.1%, possibly on the heels of some comments from Fed officials yesterday. Take a look at 2s, 10s, and 30s, and you can see in the bond space, particularly on the front end, a bid. And this really comes after we saw San Francisco Fed President Mary Daly in an interview with the Wall Street Journal say she would support a Fed rate cut next month. She is not a voting member, but definitely is considered an ally of Fed Chair Jay Powell. There also has been Chris Waller, who wants to go. Of course, John Williams has also indicated, which is the reason why you are seeing a bid into that space. Here are your morning movers with Vonnie Quinn with 2 hours away from the cash open.
Well, Lisa, one of the narratives that's going to dominate today is TPU versus GPU, right? What are the switching costs? Would companies want to even switch? And that's because Apple is in the news, obviously up 4.25%. Meta is in talks, according to the information, to buy billions of dollars worth of Google's TPUs. Now, it could have gone the other way. It could have gone and bought Nvidia's GPUs. It didn't. And the question is, are TPUs better for inference? Are they more energy efficient? What would it mean down the road? Does it mean the beginning of the end of the Nvidia dominance? It's a big question. So you can see Nvidia down about 3.5% off its lows of the session, AMD down 3.8%, and those Alphabet shares rising. Let's get to some of the retailers now, because we had many report today. One of the better stories, Kohl's up 22%. That stock already up about 12% this year. So the interim CEO, Michael Bender, who was put into the position in May, has really proven himself in the third quarter, definitely stabilizing Kohl's. He has now been named full CEO. He is in that position from now on, and today bears him out. So sales were still down, but only by 1.7%. The estimate was for a decline in the third quarter of 3.9%. And for the full year, the outlook is now comp sales being down 2.5% to 3%, as opposed to down 3% to 4%. So you can see the ranges are a lot better. Different story at Dick's Sporting Goods. So Dick's down about 10% on the year, down another 8.5% today. It did raise its outlook for a second straight quarter, citing sales from existing stores. But consumer sentiment down in November, as we know. And this, how does it, bring Foot Locker into the equation? Well, CNBC is saying that it's actually going to sell some of the existing Foot Locker stores. And so that's one of the parts of this story. Adjusted earnings per share missed at $2.07. The full year forecast did get boosted, though, but obviously investors not buying this particular idiosyncratic retail story.
Thank you so much, Vonnie. There is this question of Abercrombie and Fitch as well. Those shares popping more than 10% after reporting better than expected earnings across the board. We'll get to that in a bit. What you are seeing, though, is, Danny, a sense that their third quarter comp sales came in not exactly well. They came in actually below, but you did see overall net sales increase and a sense going forward, some commentary saying people are really buying more strongly heading into the holidays.
It does contrast with what we've heard elsewhere, to be fair. You've had, Vonnie was just talking about Dick's Sporting Goods trying to close some of their Foot Locker locations. It speaks to this moment where if companies do innovate, and Abercrombie & Fitch has really changed their lineup, or you look at Gap, who's leaned into celebrities and different collaborations, that there is money to be spent. It's a story that's been evolving for the past few years. It's a consumer that has money to spend, but it's choosy, which makes it hard to develop an overall narrative about where we stand.
Yeah, the commentary coming from the C-suite. We achieved 3 years of consecutive quarterly sales growth, delivering record third quarter net sales with 7% growth to last year. The strong finish to back to school and fall seasonal transition very much front and focus. Meanwhile, spending on other things is on our radar this morning. Meta reportedly in talks to use Google's AI chips in data centers. According to the information, the agreement would help establish Google's chips as an alternative to NVIDIA's. The deal hinges on whether the chips demonstrate power, efficiency, and computing muscle. That is what Vonnie was talking about with TPUs and GPUs. Meanwhile, Apollo CEO Mark Rowan saying, quote, people have really just lost their minds when it comes to concerns over private credit. Rowan rejecting the idea that adding private assets to retirement and insurance portfolios can pose a systemic risk. Danny, this is what we've heard from so many of the titans of the private asset management world.
Yeah, because it's really hurt them. I mean, you look at the share price of these publicly traded companies of private credit, private equity, and they have been really damaged by it. I think it's a fair argument to make that it's not systemic. There can't be a run on the bank with these kind of companies. But maybe what some of the wobbles do demonstrate, and Mark Rowan has talked about this, that we are late cycle dynamics. So much money has been poured into the sector. It's no longer a niche corner of finance because of insurance money, because of the move into wealth. And that money has to be put at work. So has due diligence softened? Has it been moved to the wayside? And does that mean the certain blow-ups or at least stress you've seen just does become more commonplace?
So late cycle in private credit, early cycle in the economy, early cycle in some sort of downturn. I'm getting lost in terms of what inning, what cycle we're in, because I've heard 5 things this morning alone, Danny.
Yeah, maybe we're just, the cycle is dead. Maybe that's the answer, that the cycle doesn't exist.
Well, maybe we'll get some inclination from U.S. economic data. It is getting back on track. Sort of. Delayed September PPI and retail sales due this morning at 8:30 a.m. September PCE now set to be released on December 5th. Meanwhile, a slew of results from the retailers, as we've been talking about, continue to give insight into the U.S. consumer. And sticking with retail, just days away from Black Friday and the unofficial start of the holiday shopping season. Lauren Murphy, Retail Finance Managing Director of Wells Fargo, writing, holiday shelves are full, but prices may rise in 2026. Lauren joins us now for more. Lauren, thank you so much for being with us. We've been trying to get a read on the holiday shopping season this morning in an ad hoc way with all of the earnings reports that have been coming out. Do you have a better sense of exactly any consistent themes running throughout the retailers?
Yeah, so I think the good news is retailers, as I mentioned, are well stocked. The inventory is on the shelves. They're ready to meet their consumer where they're at. I think the constant theme is just this question of consumer sentiment and really what is going to be needed to get that consumer and traffic in the door this holiday.
Lauren, there have been various notes this morning. One from UBS Securities saying that consumers' willingness to spend has waned and they expect a mediocre finish to the U.S. holiday season. BMO on their survey saying that consumers are going to raise their spending on the holidays more moderately than they have in the past. What are you seeing? Are you also seeing that softening around the edges of a consumer spending this holiday season?
Yeah, so Wells Fargo economists are forecasting that holiday sales will be between 3% and 4% increase year over year. However, that is not accounting for inflation. So I do think that consumers are seeking out value, they're seeking out discounts, and they're really mindful of their wallet this holiday.
A lot of what we've heard from the retailers too, Kohl's being one of them, having a really good quarter, Best Buy, another one that's lifted their outlook because everybody is buying the new iPhones. Lauren, if there is this concern, is there a scenario where people have spent all of this money because they're concerned about the future? They're concerned about where prices go, where employment goes. So past strength can't necessarily be indicative of future strength.
That's right? This is still the prime time spending season between November and December. And we think retailers did a really good job trying to keep prices low heading into this holiday, pulling up forward inventory purchases ahead of price increases. I think we're seeing that in the results. We haven't seen the margin hits that we were probably anticipating. However, what we're hearing from our retailers is that may be coming in 26, right? They're trying to hold the line right now. However, the question is if they're going to have to increase prices just because they can't sustain it any further heading into 26.
And this goes to a question a lot of people have been asking. Have we already felt the ramifications from the tariff costs? Have they already been borne by a lot of these companies, or are they yet to come? Are you saying that they're yet to come?
Yeah, I think what we're hearing is there is a lag, right? Where people are, what we're seeing in the margins today are still at that pre-price increase because they pulled forward so much inventory in the first quarter. However, what we're hearing is that we do think that there will be further margin prices heading into Q1, Q2 next year.
Do you have a sense of how much prices will increase? Is it just commensurate with inflation? Is it beyond that? I mean, is there a range that retailers are getting a sense of during the holiday season based on what they can pass along and where now?
Yeah, I think that's a great question. I think what we're seeing, at least in this holiday season, is that there is a mixed bag of discounting strategies, right? And I think how that falls into price increases, where you're seeing retailers capping markdowns on well-selling items that still may have value that the consumer is still going to show up and buy, or they're trying to expand their discounting strategy to make sure that they're getting that more consumers are getting value for a particular product. So I think it's a mixed bag, and that's more on the margin side. But as you relate to the price increases, I mean, I really think it's going to see where they have to hold the line and making sure that they're hitting their margin forecast because they're all worried about their bottom line P&L.
What about within the subsectors, Lauren? Are there certain parts of retail that are facing price increases more than others?
Yeah, I would say right now, most immediately, we're seeing it in home furniture, home goods, right? I think because there was such a high preponderance of sourcing in China in those industries, the price increases were just too swift and they're already being passed through. However, I think we're seeing better resiliency in apparel and some specialty items as well. So I do think consumers are going to hopefully benefit from that this holiday season.
Is the home goods also an issue, just the fact that we've seen some of the big box home improvement stores that they continue to lag because of issues within housing? How does that trickle down to a home goods sector, for example?
Yeah, I think furniture is a good example, right? We're seeing a little bit more distress in that sector, knowing that just consumer spending, discretionary home sales, et cetera, right? People aren't going out purchasing houses, therefore they don't need to furnish these new houses. And so I do think that we are seeing the immediate impact of that across the sector.
Lauren Murphy of Wells Fargo, thank you so much for taking the time. And Danny, do you go to the store ever on post-Thanksgiving and celebrate by shopping?
As a creature who has a natural level of built-in anxiety, I can't do it because it skyrockets. I am one of the ones comfortably on my computer, like a cup of hot cocoa on one hand, scrolling through the deals. That's more my speed.
I think that you're more the common denominator,
Probably.
that you are the exception at this point, given how many deals and offers I've been getting in my inbox. But it seems like people definitely decked out. Interesting to see some of the retail earnings that have come out this morning. A more positive tone than not, aside from Dick's Sporting Goods, but a sense that if you have a product that people want to buy with efficiencies, a lot of them are resurrecting some of their post-pandemic malaise.
But that's also why I'm kind of scratching my head, looking at, again, the notes that I mentioned from BMO and from UBS Securities saying that this is a consumer whose spending is waning. You're not necessarily seeing that across the board, but maybe it gets back to this issue we've been dealing with. People will say one thing and then they still buy when faced with deals.
Yeah, this has been the conundrum. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Vonnie Gwynn. Vonnie.
Lisa, thank you. The European Union is rejecting the US's demand to ease tech regulation in return for lower steel tariffs. The EU's antitrust chief says the bloc's digital rulebook is, quote, not up for negotiation. The comments came after Commerce Secretary Howard Lutnick told Bloomberg his administration could relax levies in return for the rollback. President Trump signing an executive order on Monday establishing the, quote, Genesis mission, a federal effort to boost innovation using AI. It aims to coordinate research done by government agencies to integrate AI tools. Officials say the push will accelerate scientific discoveries in engineering, health, sciences, and energy. In sports, the San Francisco 49ers beat the Carolina Panthers on Monday Night Football. 49ers running back Christian McCaffrey had over 140 yards from scrimmage and a touchdown, while the San Francisco defense held Bryce Young and the Panthers to just 9 points. The Niners improved to 8-4 on the season, and Carolina falls to 6-6. That is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, powering the AI build-out.
We are in the midst of a major technological transformation that sure requires a lot of chips and requires a lot of data and data centers, but also requires a lot of energy.
Samantha Dart of Goldman Sachs joining next. This is Bloomberg Surveillance. Day 3 of a rally after 2 straight days of gains that were some of the biggest that we've seen since the post-Liberation Day rally. We are seeing an S&P futures, at least, that are turning around after being down as much as 0.2% earlier. NASDAQ also turning around as people get a little bit more optimistic about the efficiencies and some of the new progress and new developments going on there. You are seeing a little bit of a lift in longer-term yields, but just 4.03% on the front end of the yield curve. You do see a bid with the Fed very much in focus. San Francisco Fed President Mary Daly endorsing the idea of a December rate cut. Under surveillance this morning, powering the AI build-out.
Everything is about energy, right? Energy and technology are the main drivers of productivity. And we are in the midst of a major technological transformation that sure requires a lot of chips and requires a lot of data and data centers, but also requires a lot of energy. So the technology and the energy are combining.
Here's the latest. Electricity demand set to surge as the race to revolutionize AI calls for more energy. Samantha Dart of Goldman Sachs writing, as AI demands massive power, a reliable and ample power supply is likely to be a key factor shaping this race. Samantha joins us now. Sam, thank you so much for being here. Let's start there. The idea of a race against whom? Is this China versus the U.S. and a question of who can get the most computing power and then who can actually power said programming?
Yeah, these are the two front runners. You have today the U.S. holding over 40% of all data centers in the world right here. But China's number two, a little over 20%. And when we look at what's ahead, do we have the capacity to keep this going? I think that's where the differences really start to show, because in the US, we're already seeing about 8 out of the 13 power markets, regional markets in the US, already strained during peak summertime. Whereas in China, spare capacity is not only much larger, but we estimate it will get even larger over the next 5 years.
So without the U.S. building massive amounts of power the next 5 years, which is really going to be the time when AI is really ramping up, this really comes down to efficiency and how much more efficient can chips get, which is the reason why everyone's focused so much on Google today and this idea of their TPUs, the idea of a more efficient chip that uses less energy versus NVIDIA's GPUs. How much is that important and a necessary ingredient for the AI race to really continue in the United States?
I think it's key, because otherwise we're just not going to be able to add enough capacity to continue to fuel this. So, for example, already this summer we saw the Eastern Atlantic market in the US, the power market, really tight. We saw real-time power prices spiking to reach record highs. We saw capacity auctions reaching record prices. So it's the market positioning not just to price your peak summer price very high, but hey, we're going to need to pay utilities a lot more to build additional capacity in the long run, because what we have is just not sufficient. So either we get more efficient, or we're going to start to see bottlenecks, or at least a slowdown in the addition of data center capacity in the U.S.
How much is there a timing mismatch? Because everybody's running to the gold rush, the field of dreams, build it and they will come, trying to build more energy capacity. Presumably it takes some time for these to get online. Is there a concern that we are ramping up so much with our demand of AI and what we're expecting versus the ability of these projects to come online?
Yeah, it's almost like you have two lines. The data centers are coming in troves, and on the power generation side, it's not that it would normally take so long. You would ordinarily build a natural gas-fired power plant in 2 years if you had the turbine. But we have a 4 to 5 year queue to get a new turbine if you want to start a project today. So you're having to rely on other sources. And what do you have? Well, we're still building a lot of renewables, but they are intermittent, so they are not always there. You need something to back it up. We can't build nuclear because every time we try, it takes many, many more years than planned, and it costs a lot more. So we're sort of running out of options if we don't have that efficiency gain in the very near term. And the result ends up being that our peak summer periods are going to be tighter and tighter in power markets and giving room to price spikes and potentially even outages.
All this conversation also just always leads me to think, what does Europe do? Europe already faced an energy crisis. They're still trying to wean themselves off of Russian energy. Can they compete when even without data center demand, they struggle to get the capacity that they need?
Yeah, I think it's unlikely they can compete. And a lot of that is because they haven't even secured their energy sources. So when we think about who has enough energy to power all of this, and the US has already become an energy net exporter. But if you look at Europe, even though a lot of Europe is not using Russian gas, for example, anymore, that dependency just switched to imported liquefied natural gas. You still have to import it. So almost 50% of Europe's energy has to be imported. So that dependency is still there. The grid is very old. They don't have rare earths. They don't have uranium. So it's a very vulnerable place to be.
So let's start talking about some price levels. Liquefied natural gas, how much do you see prices increasing, say, in the next 12 months?
Actually, we're now starting a wave of supply growth in liquefied natural gas, and the U.S. is a big driver of that. The U.S. is going to drive more than 50% of global growth in LNG supply. So that's the bright side for Europe, if I can find one. is that their access to energy is likely to become more affordable over the next several years.
So this is the conundrum. You have, on one hand, the liquefied natural gas prices going down because of supply. You have actual gasoline, diesel, also diesel, I guess less so, but prices going lower because of the supply glut that you're seeing coming out of the Middle East and other places. So where is the crunch going to happen, right? Where are the prices going to go up so materially that people are going to really feel the pain?
Yeah, I think at least in the U.S., what we're seeing so far is that the bottlenecks and the price pressure points, I think, are more likely to show when it comes to power price than, for example, natural gas prices or even gasoline prices. So it's really a power story a lot more than gas.
This is an administration that's increasingly been focused on affordability in recent weeks. If the net result of what you're talking about is everyday consumers also feel that higher energy price, is there anything the administration can do to solve these bottlenecks, or do they just need to be worked out?
That's a great point, because we're here talking about potential bottlenecks on infrastructure. But if it becomes a political issue because electricity prices are rising, that becomes another type of bottleneck. And because we can't really fix infrastructure building that fast, the only thing that policy can do is just make permits come a little faster. But if we can't get a turbine in less than 5 years, we still have a problem.
How much is this ultimately going to rest with the hyperscalers having to pay for the power themselves and create their own power plants themselves, which to some degree they're doing off the grid to some degree that could essentially become stranded assets? But how much is that kind of the path of travel going forward?
That seems to be the path of travel, but they will face those same bottlenecks. They still need the gas turbines for their own power generators, even if those are off the grid, right? If they are separated from the grid. And by the way, even if you have a generator off the grid, as your capacity grows, if your power demand grows with it, by the time you reach that generator capacity, guess what? You need to connect to the grid eventually anyway.
So what's the trade? I mean, if you're going to advise investors on what to invest in to capitalize on the demand outstripping supply, where do you go?
So there are a couple of things to think about. I think from a U.S. perspective, we think the trade is much more focused on power prices. So one thing that we have raised to clients is, hey, look at the back end of power price curves, because we're going to need to incentivize more build out, and that's going to show up in the back end of the curve. But if you turn around and look at Europe, for example, we were talking about all that vulnerability. You need to import a lot of materials. You don't have rare earths. You don't have this. You don't have that. So we have been recommending that investors in Europe in particular hold commodities in their portfolio as a hedge to all of this going wrong.
Samantha Dart of Goldman Sachs, thank you so much for being with us. Really appreciate it. Sam Dart there, talking about the power demands. And this is going to be an affordability issue. And Danny, I'm so glad that you brought that up, because increasingly there was a chart that I saw that prices for energy have remained steady because gas prices have come down so much that's offset the increase that so many people have already felt in their electricity bills.
And what happens if that reverses? And how does politics get involved? It's happening in multiple sectors, this idea of crowding out. It's happening in electricity, also in manufacturing. A really great Bloomberg story a couple weeks ago that manufacturing spending, not AI related, has started to trail off. So a lot of the capital, resources, energy increasingly going to the dominance of AI.
Yeah, and to retailers, which is what we've seen this morning, which we'll be talking about coming up as we get some retail sales data from September, as well as, of course, ADP numbers coming out at 8:15. Coming up, Joe Amato of Neuberger, Berman, Tracy, Chen of Brandywine, Pooja, Sriram of Barclays, and Krishna Memani of Lafayette College. This is Bloomberg Surveillance. Good morning.
The reality is the fundamentals are still sound.
I don't think we have yet seen the real bubble trade in AI.
The market's done a little bit of work here to take some of the froth out.
I think you could have a situation where the Magnificent Seven become a little less valuable and the rest of the market becomes more valuable.
We think there's a broadening out.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. U.S. retail sales and inflation data on deck in about 30 minutes as retailers kick off the holiday shopping season, with more Fed officials signaling a willingness to cut rates next month. The real question of the consumer in focus, and Alphabet displaying new market dominance on both the software and the hardware sides of the AI story, with the latest reports saying Meta may buy Google's AI chips in the years to come. Danny, showing the evolution of the AI trade into efficiencies and winners and losers.
It's not all tides are rising, or at least all rising at the same rate. But what does it mean for an industry that started to get very reliant on NVIDIA, not just their GPUs, but the funding that they're doing? OpenAI has that relationship with NVIDIA. Anthropic has a relationship with NVIDIA. If all of a sudden they're thinking, we need to change to different chips, NVIDIA starts to suffer. What does that mean to the interconnected web that it is woven?
Yeah, and is this part of the natural transition that actually is healthy, with people moving from AI is everything and superseding any kind of weakness you're seeing in the underlying economy or the consumer to, okay, let's figure out what's going on with the consumer, the underlying economy, and cater to it? It seems like right now that's the question that's bearing out in markets where you didn't see participation of the past 2 days of the rest of the 493. This morning, maybe we're seeing a little shift in tone.
Because of the earnings. It is kind of remarkable to look at the companies that have reported this morning. Best Buy lifting their outlook. Burlington, those shares dropped because apparently it wasn't good enough, but Kohl's soaring. It is some real dispersion among the retailers. The takeaway, though, is people are buying. They are buying goods, but will that strength continue? With, again, I saw a lot of bearish notes this morning. Maybe not outright bearish, but basically saying that some of the consumer is going to wane this holiday season and the pickup in spending won't be as big as we're used to.
Yeah, bearish, talking about 7,500 rather than maybe Binky Chada's 8,000 from Deutsche Bank for year-end 2026. Right now, we're seeing some of the tepid losses turn into tepid gains on S&P futures, unchanged on the day. You are seeing a bit of a bid into the bond space across the board as people start to look to the Fed to potentially cut next month. 10-year yields now below 4.02%. In the day ahead, we get ADP payrolls number coming out at just about 13 minutes time. Then at 8:30, we do get retail sales as well as PPI. And then, of course, tomorrow we do get the beige book as well. Watch for that as we try to get a sense of sentiment. Coming up this hour, we've got Joe Amato of Neuberger Berman with the latest stock rally, sort of trying to find direction. Tracy Chen of Brandywine as Google's chip challenge has NVIDIA shares falling, and Pooja Sriram of Barclays as we break down the latest, or maybe not the latest, but at least the latest that we get economic data. We begin this hour with stocks just about flat following Wall Street's best day in 6 weeks. Joe Amato of Neuberger Berman writing this: AI is a double-edged sword. Diversification across asset classes put a focus on quality, plus a focus on quality could help mitigate shocks stemming from AI-related disruption at the macro or micro levels. Joe joins us now. Joe, thank you so much for being with us.
Good to be with you.
This really goes to the heart of the question, right? Is it a feature or a bug that AI kind of marches to its own drum at a time when there are so many questions about the underlying economy? Do you think that this is a feature in a place that can actually keep equities charging higher into 2026?
I think AI is going to be a massive creative destruction process. So you're going to see a lot of winners and a lot of losers. So those companies that are able to adopt AI techniques to help protect margins, enhance their own earnings, I think are going to be the real opportunity, right? You've had the enablers rally in a big way over the course of the last number of quarters and years for that matter. So the first and, as I call them, the first and second derivative AI stocks. But now as that gets dispersed through the broader economy, you're going to see the benefits of that, as you saw in the early 2000s when more and more companies adopted the internet and got the margin enhancement from that.
Will the rest of the economy feel it, right? I mean, we're sitting here trying to assess the state of the U.S. economy and how much you can get this divergence between AI and everything else. Will you get a convergence as you see a broadening out of the AI-related gains in non-tech companies?
I think that's what we expect. I mean, that's what drives this broadening out theme that we're seeing. And, you're already seeing it in the context of companies talking about use cases to gain efficiencies, whether it's Walmart talking about on their quarterly earnings about not really increasing headcount over the course of the next couple of years, yet showing good earnings and good margin improvement, right? So they're figuring out ways to get that efficiency from adopting these technology tools.
There was a study I was looking at from Kyndryl, it's a spinoff from IBM, which does consulting for different companies, saying that 62% of companies who are trying to implement AI are in pilot purgatory, as in they're trying to find ways and experimenting with ways, but haven't actually cracked the nut. If we are going to see productivity play out, how long is the timeline? Is this something you expect to be adopted and put into motion very quickly, or is this a multiple years long trajectory?
I think it's going to happen faster than the integration and adoption of the broad-based internet, we think, which took a good decade or so. But that said, it's a challenge, right? We see it in our own firm, right? There are use cases we develop for our investment professionals that can be quickly implemented and find real efficiencies in their investment processes. At the same time, when you're changing workflows and you're affecting multiple areas of, in our case, our firm, or the examples you're using, it's a little harder. It's going to take some time, but I think it's coming. And some of the studies that we've all read about, seen, whatever, around questioning the return on investment or the efficiency gains, it's just too early to tell. I mean, we see it, like we've been in what I would consider an early adopter at our firm. I mean, we were pushing out these tools in the summer of 23 for folks to start using. Yet we're still in the, I would say, early innings of really having it more integrated in the entire firm.
So does that mean you're not in the camp of, oh no, the financial services industry is about to lose all of its junior employees because ChatGPT is going to develop some model that takes away the grunt work?
I do think that AI is going to put pressure on low-end white-collar services jobs, and that's a lot of what the folks coming right out of school. So what you're seeing now, college grads are struggling to find a job. Right? We're all seeing that the level of youth unemployment is higher than it's been. So that's worrisome for the labor market, right? At the same time, from the financial services industry, they can gain those efficiencies where you didn't need to necessarily have as many young folks as you needed before.
How are you understanding the recent declines that we saw before 2 days ago, before last Friday, in the AI space? I mean, is this an opportunity to buy? Is this a sign of tightening liquidity? Is this a sign that maybe people are getting less patient? And how are you sort of using this period to reset going into 2026?
We had a massive rally in those enablers that I talked about, right? The first and second derivative AI stocks. So having a pause, considering the challenges, the question whether, the pace of AI investment is going to continue at that level. What are the hurdles, right? I heard your last guest talking about power. Power is going to be, I think, an important element of the AI trajectory. But, as we move into 26, we're optimistic. I think we see the economy running, particularly here in the U.S., at a reasonable clip. Third quarter could be in the 3+ range for GDP growth, which is pretty remarkable. And when you think about the level of job growth that we've seen in the third quarter, it tells you something's going on with productivity, because we had it seems we'll have reasonable economic growth, yet modest amount of job growth. But as we move into 26, earnings are in good shape. Economy seems to be running at a decent clip. And we think the Fed directionally is cutting rates. And that's a good foundation moving into the new year.
Your characterization is different than what we heard yesterday from the likes of Mike Wilson over at Morgan Stanley, as well as Oh-Sung Kwon over at Wells Fargo, who is talking about a real tightening in both liquidity as well as a sense that the economy was flagging and that it wasn't necessarily productivity. Sort of the jury is still out about why we haven't seen more job growth and why we have seen ongoing earnings from corporations. They were saying they expect aggressive rate cuts, quantitative easing, essentially, by another name, and fiscal stimulus coming in. How much is that part of your thesis for 2026?
Well, I think the fourth quarter is probably going to be a little bit of a soft patch because of the government shutdown. So it won't, we don't think the run rate of the economy in the third quarter is going to continue in the fourth quarter. But I think we do expect to pick up in 26 based on rate cuts, based on the stimulus in the bill, which is very much front loaded in calendar year 26, purposefully so by the administration. Surprise, surprise. So I think that builds, again, a foundation for a better environment. This is what makes markets. People have different views on the pace of economic activity. I mean, we're reasonably sanguine about where things are right now.
When it comes to what makes markets and the structure of it, do you take anything away from the last 2 weeks where you had a risk off that really felt to be led by high momentum names, by crypto investments, and it had a spillover effect in the whole market? Is there some sort of fragility or at least concern you can take from that and extrapolate into 2026?
I think we saw a fair amount of frothiness, and I don't think you have a market rally as hard as it has, or in every bull market, you're going to have some level of excess excitement, if you will. So that coming back to reality is a good thing in our view, right? And again, it also plays into the notion that it's not just about those AI technology stocks that are where you want to be. I think you want to think about how that broadening out it becomes an opportunity from an equity market standpoint.
A lot of people, though, have been punished, either one, missing some of the AI stuff or trying to outright bet against it. Michael Burry is traded in his hat as a hedge fund manager to be a Substack writer, apparently, because of it. And there's this really interesting Goldman note I was reading. People who want to short this market seem to be playing it through utilities. 3.2% of free flow to short interest isn't a huge amount, but apparently it's one of the highest on record. And they reckon that it's a way to play against AI. If someone were to come to you and say, Joe, I'm nervous about AI, what would you tell them to do? Can you be short this market, or do you need to turn somewhere else?
I would be careful shorting this market. I think because of the foundations that we talked about in the expansion that we see in the broadening out. But you know, you're going to see a lot of this, as I referenced, this creative destruction process. You're going to see a lot of winners, but you're going to see a lot of losers, and it's going to happen faster than people think about. So does it create an opportunity to short individual names versus, you know, the losers that you think versus the winners? I think it does. You know, that level of dispersion and single stock volatility, I think, creates those opportunities. But from a broad-based standpoint, I'd be careful to be short.
Yeah, it might make people feel more confident, actually, to be long. Joe Amato, thank you so much for being with us. Joe Amato of Neuberger Berman. That's what a lot of people have been saying on the show, right? Danny, the more people talk about bubbles, the better they feel that there isn't one.
Well, also, if you're in the beginning stages of a bubble, the best thing you can do is buy and to ride it to the top. But yeah, a lot of people have been punished betting against it. Michael Burry, kind of a poster child at this moment, I think, for that.
But Substack, a warm and fuzzy place. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. Kohl's share is jumping in the pre-market after it reported third quarter earnings that topped analysts' top and bottom line estimates. The retailer also posting better than expected comp sales and raising its full year outlook. Best Buy share is also rising. The tech retailer reported strong third quarter earnings that beat estimates. The company boosting its full year adjusted earnings per share guidance and projecting higher comp sales and revenue for the fiscal year. And in tech, shares of Google parent Alphabet rising in the pre-market on reports Meta is in talks to spend billions of dollars on the search giant's AI chips. The information is reporting Meta plans to use Google's tensor processing units, or TPUs, in data centers from 2027. An agreement would help establish TPUs as an alternative to NVIDIA's AI chips. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, we'll be breaking down the ADP employment report, plus Tracy Chen of Brandywine as Alphabet has its sights set on $4 trillion. That's next. You're watching Bloomberg Surveillance.
The AI theme has just come to the investment grade market. One of the risks is it starts to lift yields across the board and starts to make the cost of capital more expensive for other companies. That ultimately could be a drag on growth down the line. The investment grade market was, practically invented for this. It's going to be a while until we get to a point where it starts to degrade.
That was Al-Hussainy of Columbia Threadneedle speaking just moments ago. As we head to the market open, we are looking for those economic data points, including ADP. We will bring them to you when we get them. Right now, I believe that the ADP numbers just crossing. Let's head over to Bloomberg's Michael McKee. Mike.
Good morning, Lisa. Well, this is not good news, considering it's the second week in a row that we see a decline in ADP. Average 13,500 jobs a week were lost in the 4 weeks to November 8th. Now, remember, this is a 4-week moving average, and it's also a couple of weeks behind, but it is the latest information that we have from ADP, and it isn't particularly good news. We will get the monthly numbers next week, and that may give us a better clue as to where the labor market is. But it certainly looks like The weekly ADP numbers, to the extent you can trust them, are making the case that the doves were making the last couple days and suggesting that the Fed might want to cut rates again.
The idea that private payroll losses are accelerating in the past 4 weeks, Mike, speaks to what we heard in the Wall Street Journal article with San Francisco Fed President Mary Daly when she was talking about how she has seen a real-time deterioration in the labor market. How much is that sort of coalescing, that idea kind of bringing together a lot of the Fed members based on just what's happening on the ground over the past few weeks?
Well, you look at the number of open market committee members who have said they are open to or want to cut rates. And you can see that there is a trend that has solidified since the last Fed meeting when Jay Powell told us it was not by any means a foregone conclusion that they would cut. It seems that a lot of these Fed officials talking to businesses around their districts have seen that companies are going ahead. And this was always a question out there, would be when do companies have to make a decision one way or another about personnel while they wait for the confusion about Trump's economic policies to clear up? Hasn't cleared up, and they do seem to be making some decisions now.
Thank you so much, Michael McKee. We are seeing just a little move in bond futures, although not significantly. 2-year yields lower now, more significantly to 3.47%. Now the bonds across the maturity spectrum getting a bid. Time now for the morning calls. First up, BMO Capital lowering its price target on Novo Nordisk to $46, expecting negative headwinds for 2026. Next up, Mizuho lowering its price target on Tesla to $475. Noting weaker electric vehicle makers in China and the U.S., those shares essentially flat. And finally, D.A. Davidson keeping a neutral rating on Alphabet, seeing increasing demand for Google's TPUs following a report from the information that Meta is in talks to spend big on the company's AI chips, and Google shares up 4.3% in early trading. Sticking with tech, NVIDIA, the other side of that, shares falling following that report from the information. Tracy Chen of Brandywine Global writing, the winner-takes-all mentality in the United States has led to aggressive capex spending and hoarding of computing capacity, which is gradually diminishing free cash flow. Tracy joins us now. Tracy, thank you so much for being with us. I want to just start with a question of how much we're seeing the winners and losers shake out now, or we're just getting a hint of what it's going to look like, say, in 6 months.
Good morning, Lisa. I think we are still in the early stage of this AI investment or AI arms race. Right now, we are still getting some little hint about this winner and loser because today you can see Google share up and NVIDIA share down. I'm not saying who is the winner, who is the loser, but you start to see this differentiating market response to this AI development. Because before we have seen anything that touched AI, we will see the stock up, right? But now we can see the differentiation, and which is a healthy development.
Does that mean, Tracy, it doesn't pay off to play this passively? Considering we're starting to see some of the differentiations between companies, do you want to be actively managed, not even only in just picking sectors, but within some of the hyperscalers and big tech concentrated around AI?
Definitely. So if you look at their capex spending as a share of the free cash flow, you can see a divergence among the Magnificent Seven or AI 30. You can see some companies already over 100%, meaning their capex spending already exceeding their free cash flow. But some companies, the percentage is still below 20%. So you can see who is really stretching and who is still having a lot of free cash flow room for expansion.
So, Tracy, year to date, it's a market that the best performing sectors have been anything AI related. Communication services is number one, then infotech, then utilities, then industrials. Again, those last two you could argue about AI. The thing that's been left behind and has barely inched to a year to date gain is consumer staples and consumer discretionary stocks too. We have a whole host of earnings coming out this morning of some of the retailers. Some of them are strong, some of them aren't strong. Tracy, when can you jump in and buy these parts of the economy that don't touch the AI related story?
I think next year we should see a broadening of this AI theme, especially if you look at the key shape economy of the U.S., especially the consumers, the haves and have-nots. I would think that if you look at the consumer discretionary, that has been outperforming the consumer staples, and that I think next year would probably will accelerate this kind of dispersion. But if Trump is tackling the affordability problem, we will see this trend probably reverse a little bit, and the AI expansion theme or broadening theme should continue next year.
There's been about $200 billion of debt sales tied to AI in just the past couple of months alone. I mean, I feel like it's been an absolute bond bonanza over the past couple of weeks, and I'm just wondering at what point you say no mas. I mean, as an investor, are you buying, or are you saying I don't really want to get stuck with this stuff?
Yeah, I think I'm more optimistic of this AI investment theme. I think we're still in the early stage. As an investor, you just can't miss this secular trend. AI revolution is so massive, right? It's arms race not only within the U.S., but also between China and U.S. And the government will support this investment. So I think the market actually give the message that the hyperscaler or hyperspender, you have to slow down. And this kind of winner-take-all mentality might not work out as well, because in China we see it's not winner take all, it's winners share all, right? So there are several companies they share with each other their know-how and they build something together. But in the U.S., you can see this aggressive competition because of the winner take all mentality, and this aggressive new issuance in the IG corporate market definitely get some pushback from investors, right? Investor will give them more scrutiny to see the monetization pace, right? Whether the monetization will go well or not, and they start to differentiate between among different players. And I think we are going to see some spread widening next year in the IG corporate market, and this will actually have some pressure on the long end of the treasury curve. That is my view. But as an investor, you can still play some short duration like data center ABS, and it has a structural protection as well. So you can diversify your portfolio and be very active and have some active selection, and you should have an attractive return.
Tracy Chen of Brandywine, thank you so much for being with us. Just digging into some details now from the ADP report. Joining us again, Bloomberg's Michael McKee. Mike, we've got some more details about what potentially is causing the deceleration and where the bright spots are and where the weak ones are.
Well, we don't really have any particular bright spots other than healthcare, which has been normally the biggest job creator. The weaknesses have been concentrated in manufacturing and construction, and those don't seem to be improving. And what's interesting is that ADP had previously reported a gain of 42,000 jobs in their monthly report for the month of October. And this report that's out today covers the 4 weeks up until November 8th and suggests a collective weekly average loss of 13,500. So those two don't square exactly. And this is much more of a gloomy report. This would take you into the first week of November and the last 3 weeks of October. So it's hard to get a clear reading on where the economy is at this point. But it does suggest there's some question about how strong the economy, the labor market is.
Michael McKee, thank you so much for that. You do see two-year yields falling in response to this report, leading into the data that we get just in about 5 minutes' time right now. You're looking at a decline of about 3 basis points, not that much drama in the two-year yield, but nonetheless, Danny, definitely raising questions about the trajectory and just how stale September data is in a very rapidly moving labor market.
And that's why you care more about data points like this, and it also feeds into the Mary Daly argument that the labor market is more concerning, because if there should be a linear move, that's more difficult to control than inflation is.
Yeah, coming up, we are going to be speaking about retail sales and PPI. That's due in less than 5 minutes' time. Pooja Sriram of Barclays joining us to react to the ADP figures, as we do see a shift, at least in tone, from the jobs landscape. This is Bloomberg Surveillance. 25 seconds away from retail sales and PPI data from September. Right now, the state of play is lining up like this. You are seeing a bit of a lift in equity futures. S&P futures higher just a touch by less than a basis point. Meanwhile, you've got NASDAQ futures just meandering. Again, you are seeing the Russell 2000, though, with a lift of half a percent, which really comes in the heels of the rally that we're seeing in the bond market, 2s, 10s, and 30s. You are seeing that bid. Right now, we are getting that data. Let's head over to Michael McKee with retail sales and PPI. Mike.
Oh, Lisa, we've got a little bit of a disappointment in terms of retail sales. Headline retail sales come in up 0.2%. They were up 0.6 in the month of August. Now, remember, this is September data. The expectation was for a 0.4 rise. Ex-autos were up 0.3, which is what was forecast. But the control group, we don't have that number yet, hasn't come through yet. We'll get that for you in just a second. But ex-autos and gas up only 0.1%. So a lot having to do with prices there. In terms of PPI, the headline PPI comes in up 0.3%. It was down 0.1 in the month of August. So there's a little bit of an inflation issue there. The core rate up 0.1%. PPI on a year-over-year basis is up 2.7%. That's a tick up in September from August. And PPI core on a year-over-year basis falls by 0.2 to 2.6% from 2.8%. Retail sales control group comes in down 0.1% after a 0.6 rise in August. So retail sales weaker than expected. Inflation a little bit hotter than expected, but mostly in the headline groups, which probably suggests the same thing as retail sales, that gasoline prices, energy prices, and car prices may have played the role there.
We've seen a little bit of a build on the market moves that we saw after ADP. We see the bid into the front of the yield curve continuing with 3.4668 if you want to go out to the fourth decimal. The sense that the Fed is going to be prompted to cut rates based on the fact that heading into this holiday period back in September, there wasn't that much momentum, or at least as much as people had expected. And that, yes, inflation maybe at the headline level a little concerning, but under the hood, not so much. Mike, how important is data from September that we're getting now? How do you understand this in the scheme of understanding an economy that seems to be rapidly moving?
Well, I think you hit the major problem there, Lisa, by saying the economy is rapidly moving, because the Fed can't take a lot of comfort in this data one way or another, even having it, because it just tells you where we were 2 months ago. And that is way behind where we may be now. The real question is, what, in terms of retail sales, are we going to see in this holiday period? We've got Black Friday coming up to kick it off. And when you look at what we saw in the retail sales numbers, car sales down 0.3%. Gasoline stations were up 2%, but that was after a 3.1% gain. So gasoline and food, part of the problem here. Clothing and accessories down 0.7 in the month of September. And the sporting goods, hobbies, toys down 2.5%. General merchandise up only 0.1%. People weren't spending money on the things that we're going to see them, in theory, spending money on for the holidays. So it is a bit of a warning that consumers are a little concerned. We've seen that in the consumer expectation numbers as well.
Maybe, which is why we're seeing Dick's Sporting Goods shares falling and them closing some Foot Locker stores. Bloomberg's Michael McKee, thank you so much. I'm sure there is more to it. Let's head over to Pooja Sriram of Barclays, who joins us now here in studio. Pooja, thank you so much for being here. What's your initial read on not just the numbers that we just got, but the importance of them based on the fact that they're pretty old?
Yeah, I think, look, in a situation where we haven't been getting a lot of fresh data, some data is useful. I would say this helps sort of fill in the gap between what happened before this holiday season. And if anything, it's slightly useful. You're able to build on a trend in terms of what was happening in the economy heading into the holiday period. But I would not deny that it is a bit backward looking.
Is there a little bit of a tension between Mary Daly, someone who's very close to Chair Powell, saying that she is more concerned about the labor market, John Williams saying that he would endorse something of a cut, again, the top lieutenant at the Fed, versus the last time we heard from Chair Powell talking about this data fog, saying that when you're in that fog, it makes sense to move slowly. Is there tension in those things?
I don't think so. Look, I think one thing that seems to be clear is everyone is having a hard time figuring out if policy is generally restrictive, and people have very different views on that. In addition to that, like you said, the data fog makes it difficult, but the doves have something to pick on, and that would be the rise in the unemployment rate that we saw last week, maybe even this morning's weak ADP data, although I do think it's somewhat of a noisy signal. And on the other hand, you have some of the others, the hawks on the committee, who are generally worried about inflation and would like to see more contemporaneous data, perhaps, before making the move. So I think there's just a genuine difference of views.
And do you think that genuine difference of views continues on because of the fog, or has something fundamentally shifted at the Fed, especially as you get more politics injected into it? Do you expect that, regardless of how some of the data shakes out, that just lack of consensus is the new normal?
Well, I wouldn't go as far as saying that politics is coloring how the Fed is thinking. It's just, we need to recognize the fact that the data that we've been getting, paints a picture of a slight tension between the two mandates of the Fed. You do have a world where labor market momentum has clearly slowed. Downside risks have emerged. On the other hand, we haven't really seen much progress on the inflation front. I think the last time I was here, we were discussing core PCE inflation has been stuck at 2.8, 2.9 since, a while now. And so I think there is a legitimate reason for hawks on the committee to be worried about the inflation side of the mandate.
How important is this holiday shopping season?
Well, usually it is reasonably quite telling of consumer momentum, the health of the consumer. Again, how much we're able to capture in the official data is questionable, just given we're coming out of a long government shutdown. But usually it's something that people look at quite closely.
I guess, how accurate can we get a reading when we take a look at something like holiday shopping? And I was struck by an essay that started to talk about how the poverty line was really referencing 3 times the average family's food bill, and that food now comprises 5 to 7% of a budget rather than a third of the budget. And so it's completely changed the equation. And what people are feeling on that lower end is a lot of significant pain that is not being reflected in any of these numbers. Can that persist? Can you have a universe where there is a growing cohort of people who are feeling a lot of pain and are not able to afford things and are forgoing a lot of basic purchases, but you have wealthier individuals that continue to spend and prop up retail spending? The holiday season does fine. Can you have that indefinitely?
Yeah, I think it's hard to answer. Indefinitely doesn't seem like it's a reasonable assumption to have, but that K-shaped economy has been going on for a while now. I think it's, it comes down to some very basic statistics, like the top 20% of your income group drives more than 40% of consumer spending. And I think that's your point, that you could have data that looks absolutely fine, even when you have a lower income group that's clearly feeling some pain. Now, just coming back to your holiday season shopping, there's also a view that consumers are now being very intentional spenders. So one of the things that some of the credit card data show is consumers have not really done off-season shopping as much this year, but it's really been a lot of shopping that's been reserved for promotion periods. So think about the July Amazon Prime Day sort of an event, and perhaps coming into the holiday season, spending may look fine.
That doesn't sound like the healthiest of developments, though, that everybody's just waiting for value or a deal. When does that become something worse? That, okay, yeah, spending's still happening because they find deals, but that in itself suggesting that there is a little bit more tension.
Yeah, I think a lot of it is also tied to the labor market, right? We've been in a labor market that seems very stagnant so far. Yes, we're not seeing as many layoffs, but there's not been too much hiring as well. That's also likely to feed into consumer thinking and sentiment. So to the extent that the labor market is just about stuck in this phase, I think caution is perhaps where the consumer is headed towards. It depends really on developments on that front.
What about then some of just the headlines coming through of Verizon letting go people, Amazon letting go people? Does that have a measure of just denting sentiment, even if people themselves haven't lost their job, but just seeing these headline figures? Does that also cause some pullback in people's willingness to spend money?
Perhaps. I mean, absolutely. The media narrative around this has been, quite immense. A lot of the headlines clearly grabbing attention. And these are big companies we're talking about. So, it can't go unnoticed.
And right before Christmas, too.
Yes. And I'm sure it is feeding into sentiment. It's making people a little more reticent to spend. But again, I think in the grand scheme of things, The extent of layoffs that we've seen are still not alarming. Yes, they've come from big companies, but I would say it's about the usual amount of friction that you would see in a labor market, which is in the state that it is right now, but surely something that we need to keep watching.
Pooja, Sriram of Barclays, thank you so much for being with us this morning, and have a wonderful Thanksgiving. Let's head back to Michael McKee, who has some details after parsing through the latest retail and PPI data that we got out of the United States government.
Well, Lisa, I want to look at a little bit of the PPI here. When you look at the breakdown of goods versus services, the index for final demand goods increased 0.9%, but services were flat. And it's the service price increases that have been worrying Fed hawks. So maybe this gives them a little bit of reassurance. 60% of the September rise in the index, the headline index overall, is traced to gasoline, which is what we thought when we first saw the numbers there. Gasoline and cars. Indexes for meat, residential electric power, motor vehicles and equipment all went up. And that's what you've been hearing pretty much from everybody these days in terms of inflation. So the Fed is seeing a picture that it basically understands, it appears. So now the question is, what kind of data do they have that tell us where we've gone from here? We do get the GDP report on now December 23rd for the third quarter. It should be relatively strong given the numbers that we have gotten. But the Fed is more concerned with where we are at the moment in the fourth quarter. And that we're going to have to wait on.
Michael McKee, thank you so much for all of that. Right now, priced into Fed funds futures is an 80% chance of a December rate cut. That is up from 35% last Thursday. So a sense of how much the market has really shifted its perception of how the Fed is going to respond. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Bonnie Quinn. Bonnie.
Lisa, thank you. So recapping that data we got moments ago, U.S. retail sales in September rising just 0.2%, half the estimate for 0.4% of an increase. Producer prices rose 0.3% month over month, which met expectations, but ticked up to 2.7% from a year earlier, which was above estimates. And in the labor market, ADP private payrolls fell an average of 13,500 per week over the 4 weeks ended November 8th. Apollo Global Management CEO Mark Rowan saying people have, quote, lost their minds over private credit fears. Rowan rejecting the notion that adding private assets to retirement and insurance portfolios could pose a systemic risk. According to the Apollo executive, most private credit held by insurers and by pension fund buyers is rated investment grade. Apple cutting jobs across its sales organization in rare layoffs. Sources telling us here at Bloomberg, the iPhone maker has eliminated dozens of roles in a bid to streamline the way it offers products to businesses. The affected positions include account managers and staff who operate Apple's briefing centers and product demonstrations. That is your Bloomberg Brief. Lisa.
Thank you so much, Bonnie. Up next, Krishna Memani of Lafayette College as traders add to December rate cut bets. Plus, Bonnie Quinn comes back with your morning movers. Kohl's and Abercrombie shares soaring following strong earnings results. This has been quite the initial read on the holiday shopping season. This is Bloomberg Surveillance.
This third quarter's results from the tech leaders show huge capital spending commitments, which will continue to boost the investment share. Open question on productivity. Longer term, we've looked at this in our long-term capital market assumptions work. We do feel that productivity is set to gain, but it's a long burn. It requires the investment first. And so we think that there's reasons to be positive.
That was Bilton of JPMorgan Asset Management joining the crowd of investors who are seeing a better 2026, potentially even another year of double-digit gains. This morning, you are seeing a lift pretty much across the board, although S&P futures going nowhere at this point, essentially flat. You are seeing, though, a bid into bonds after data that really pointed to ongoing softness, particularly in retail spending. 10-year yields now almost at that 4% level, a little bit of dollar weakness. Euro strength 115, with an increasing number of investors gaming out the idea of ongoing dollar weakness. Under an hour away from the cash open, here are your morning movers with Vonnie Quinn. Vonnie.
Well, Lisa, one of the stories out there today is when will NVIDIA's prevalence in the GPU space be undermined? And today might be the beginning of that, because we are seeing the information reporting that Meta is buying billions of dollars worth of Google's AI chips. Now, they're TPUs, right? So if people start buying TPUs instead of GPUs, then that might be a problem for NVIDIA. So we're seeing the stock suffer, AMD suffer a little bit as well, and Alphabet continue its rise. The thing is, it's a very, very big question, right? NVIDIA has been the market leader for so long now. What would switching costs be? Would companies even be able to get out of contracts? It's a very open question, and we'll be getting lots of analysis on that throughout the coming days. But let's take a look at some retailers, because here are two turnaround stories, and boy, are investors rewarding these companies. Kohl's essentially continuing the same strategy as the new CEO's predecessor. So the new CEO is Michael Bender. He's been in the job on an interim basis since May. Well, the third quarter really bore out that strategy, which was to focus on jewelry and to focus on petites. And it beat and raised, even though it was still seeing lower sales year over year and on a quarterly basis. But that said, investors rewarding that stock. Now, Abercrombie & Fitch, the same thing. Fran Horowitz really delivering there as well. For the Hollister brand, mainly, same sales, comp sales for Hollister up 16%, as opposed to a forecast for up 6 to 7% for the whole company. So not a bad story. The reverse is Burlington, right? Burlington used to be known as Burlington Coat Factory, and of course warmer weather stymied Burlington in many of major cities. At least that's what Burlington is saying. It didn't beat, it didn't raise. In fact, it missed estimates, and investors are really punishing that stock. Although, to be fair, Abercrombie was down 56% year to date before today's move. Burlington was actually flat year to date.
Thank you so much, Vonnie. I appreciate it. Have a wonderful rest of your day. Counting down to the opening bell. Here's a trading diary for the week ahead. After the closing bell, earnings from Dell and HP. Wednesday, another round of jobless claims, durable goods, and the Fed releases its beige book. Thursday, U.S. markets are closed for Thanksgiving. And finally, Black Friday, the unofficial start of the holiday shopping season, although perhaps this is a Black Week because it is clearly a full week affair. Turning to the economy, Krishna Memani of Lafayette College writing, before the shutdown, stronger hard data anchored the market expectations. The lack of hard data is giving vibes a freer space. Krishna joins us now with his vibes ahead of Thanksgiving. Krishna, why is this problematic given the fact that people have learned to depend much more on alternative data sources, whether it's ADP or whether it's some of the corporate executives on their earnings calls?
Well, I think people talk a good game, but if you go back and look at how the markets have reacted over the last 4 or 5 quarters, the vibe data has been reasonably soft, and then hard data comes out and kind of gets it out of that particular funk. So yeah, I mean, alternative data certainly is helpful, but I don't think they tell you the whole picture. That has been the case for a while. So if third quarter GDP, as Michael Key says, is going to be reasonably strong, and the underlying deficit situation hasn't changed that dramatically, at least not yet, then it's kind of unreasonable to expect for things to slow down massively despite the vibes.
Does that mean, Krishna, those on the Fed that are arguing for a cut are making that argument based off of vibes? Is that a problem if they are?
Well, I mean, part of it is vibes, but I think the labor market is certainly softening, and therefore, getting ahead of it makes a little bit of sense. I was a little surprised as to how hard Jay Powell pushed against that cut in the last meeting. So he clearly had a bit of a situation in the committee. And I think with everyone else kind of lining up, or at least the voting members lining up, he's in a much better situation. So that is getting reflected in the market prices. But there is softening in the labor data without any doubt. Not much layoffs, but not much hiring either.
So, okay, we have to read the tea leaves to understand where this economy is. And then when it comes to the Fed, Krishna, we've gotten to a place where we're counting each vote. Who's on the hawkish side? Who's on the dovish side? Who has an ear to Powell? Who's the top lieutenant that could sway things? Is it a problem that you don't have that clear message coming out from the Fed? Because as we've seen, it transmits into markets, and there's been a lot of volatility from that. In this new era where the economy is confusing and there's a divide among the Fed, is that problematic for the transmission of policy?
Well, so, if you think about it, you have two separate blocks forming on the committee. And those blocks are, the presidents on one side and the committee, the FOMC members on the other side. The challenge is when Jay Powell was in charge and there weren't all sorts of politicking going on, it was easy to kind of get to a consensus. And right now, you can't get to that consensus. So I think until the new chairman is announced, that particular challenge will probably persist with us, and we'll have to kind of slog through it somehow. That being said, I think, as I said before, the labor market was slowing, continues to slow a little bit, not catastrophically so. So I think the pushback for the last cut, for the future cut, that Jay Powell provided maybe was slightly misplaced, and the markets are basically calling him out on it.
Krishna, heading into 2026, since this is the moment of year-ahead outlooks, and everyone seems to be giving one, how are you seeing the year shape up in terms of risk-reward for the stock-bond allocation? And just, what are you baking in terms of Fed action behind that?
Well, so I think if you look at the market projections, there are a few more cuts coming down the pike. But the key thing with cuts is even if they do come, I don't think they change the tone of the market meaningfully. It'll still be driven by growth. It'll still be driven by what happens in the labor market. I think one or two cuts in the front end of the market, you look at 10 years. Hasn't really moved much despite all the talk of Fed cutting and Fed not cutting. So I think that sort of tells you how it will persist. And that's the environment where inflation is still up, so 10-year cannot drop too much, and growth is slowing down, so at least modestly anyway. And that's not an environment where risk assets do fabulously well off of very high valuations. I think that is really the challenge for the market right now.
So you see kind of a middling 2026 in terms of returns for both stocks and bonds.
Yeah. Again, there are people out there saying that it'll be another double-digit type of, a high double-digit type returns. I can't square that with what I see there. For that, everything, all this AI-related stuff has to come much before than it is likely to come. So I think the profitability outlook is decent, but it is not as superlative relative to current valuations. I think that's the biggest challenge for the market.
Krishna Memani of Lafayette College. Have a wonderful Thanksgiving. Thank you so much for joining us. It feels like a Rubik's Cube right now. It feels like people are picking up different threads of the narrative, pointing to the idea of rate cuts along with AI escalation and saying it's going to be a really good 2026. And other people saying, watch the economy and it's not so hot. What are you focused on in the next couple of hours? I know you're going to be heading over to do another 2 hours of television.
I am indeed, and it has to be the churn underneath the surface of these big tech players, because it kind of dominates all these themes, because it's an economy that's becoming more reliant on the AI spend. So if NVIDIA is kind of losing some of its throne to Google, what does that mean for all the spending, the investments, and thus the American economy?
Yeah, this is what we'll be talking about for many days and weeks to come. Coming up tomorrow, Amy Wu Silverman of RBC Capital Markets, Dan Ives of Wedbush, Deborah Cunningham of Federated Hermes, and Vinu Krishna of Barclays. This was Bloomberg Surveillance. Good morning.